Hello, all my dear students of CA Final Direct Tax Full English. I hope you all are doing good. I hope your studies are going on great. Just confirm once, are we live? Are we live so that we can start with our wonderful session on 8 MTPs, including the latest MTPs of May 2025, relevant for your exams. Now, this MTP is relevant for May 25, September 25, and also for Jan 26. And before this, we have already done with what? We have done with 9 RTPs. We have done with 9 past papers for you all in full English. And now we are going ahead with 8 MTPs today, which will be absolutely in full English, relevant for your May 25, September 25, and Jan 26. And in all, after this session, we will be completing 26 papers, which is something which is impossible. As a student, you cannot think about, you cannot imagine about revising 26 papers in around a span of 8 to 9 hours. It is impossible. But we have tried our best to make this possible, okay? So, without wasting any further time, shall we start with our first MTP today? That is MTP Series 1, November 2023. You might be knowing that in every attempt, there are 2 series of MTPs. So, November 23, May 24, November 24, and May 25. These are the 4 MTPs we are going to do. In every MTP, in every attempt, there are 2 series. So, in all, there will be 8 MTPs. Okay. So, let us start with our first question. I will take a break after every MTP. I'll complete one MTP and then I will take a break of 1 or 2 minutes only. So first MTP series November 2023, question number 1. Let's read the last line. Always read the last line of the question first of all. The last line says compute total income and tax liability. You are not supposed to compute minimum alternate tax. You are not supposed to compute as per 115BAA. It means you are supposed to compute as per the normal provision. Assassi is a manufacturer. It was set up in 2013. The profit and loss account says a net profit of 750 lakh rupees. The depreciation as per books of accounts is 52 lakhs. So you have to add back this depreciation. Okay. Next. You are receiving some power concession, tariff concession from Maharashtra state government. So remember, if you receive any concession from any state government or central government, that is an income as per section 22418. Therefore, let it be part of the income. Okay. Next one, you are paying some 18 lakh rupees as an estimated amount with a reasonable certainty as a periodical wage revision, which you do in every 3 years. So after every 3 years, you do periodical wage revisions of your workers and you make some provision for that. So that is fair enough. That is allowed as a deduction. There is nothing wrong in that. Then you have received dividend from foreign company, that is 12 lakh rupees. You have to reduce from here and you have to show under IFRS. Remember, when you receive dividend from foreign company, you do not gross up. But when you receive dividend from a domestic company, you have to gross up with the TDS. Okay, be very careful with that, which I have told you in the past paper also. Next, there is some destruction of machine and there is a loss of 17 lakh rupees. So you will add back this loss, and there is a scrap value on that particular machine of 3 lakh rupees. So you will reduce this from here and you will adjust in the WDV of the block of asset. But unfortunately, in this question, the WDV of the block of asset is not given to us. So ignore that. Okay. Next, provision for gratuity is always disallowed as per section 40A7. But whatever gratuity you have actually paid, that will be allowed under the income tax law. Okay. Next, you are doing some advertisement in a brochure of a political party. So that is disallowed under PGBP. So disallow under PGBP, but under 80 GGB, that is allowed as a deduction to an Indian company as a donation. Okay. Next one, there is some long-term capital gain of 3 lakh rupees on equity shares on which STT is paid at the time of purchase and sale. Therefore, it's a classic case of 112A. Therefore, reduce from here, show under capital gains. Now, 1.25 lakhs will be exempt. Now, assume that it is transferred on or after 23rd July. Therefore, it is 12.5%. Now, in the question, date of transfer is not given. So, I am assuming it is transferred on or after 23rd July. Therefore, I am taking 12.5% as the tax. Okay. Normal depreciation is 71 lakh rupees. The question says that ignore scrap value. So, we are ignoring the scrap value because we don't have the WDV of the block of asset. Next adjustment, you have collected some GST of 8 lakh rupees from customer and then you have paid the GST on time. So you collected, you paid, so everything is squared off. Okay. Then you filed a case with the GST department that to the High Court, and the High Court gave you a refund of 3 lakh rupees. Now, if the High Court gives you a refund of 3 lakh rupees, what is your obligation? Your obligation is to give it to the customer back. Now, you are only giving 2 lakh rupees to the customer back. Therefore, 1 lakh rupees lying in the current liability. It is your obligation to give it to the customer back. So add back to the PGBP income. Whenever you will give it to the customer, at that time you can take the deduction. I hope it is clear to all of you. And last, that's it. This is what this question is all about. Nothing great as such. The turnover of the last to last year of the company is 450 crore. Therefore, the tax rate will be 30% of this particular question. Okay. I hope it is clear to all of you. Now I am going ahead with the next question. It's a beautiful question. Beautiful question. Mark this down question. This is one of the best question of this MTP. Question number 2. It's a non-resident taxation question and it covers 4 different aspects in this particular question. First of all, let me read the question first of all for you all. Charles is a non-resident, is a German citizen and he's working in a German company. Okay. Now, so Charles is a non-resident, he's a German citizen and he's working in a German company. Now he's coming to India for some work. For how many days? He's visiting India for some official work for 85 days. So his company has sent to him India for some 85 days and the company has a PE in India and that expense is borne by the Indian PE. Okay. Now, for the time being, he was in India, he was paid 28 lakh rupees as salary. Okay. Now, whether this salary will be taxable or not, we are supposed to compute what? We are supposed to compute total income taxable in India of Mr. Charles. Okay. Ignoring the DTAA between India and Germany, we are supposed to compute the total income chargeable to tax in the hands of Mr. Charles in India. So, Charles is a foreign citizen. He is a non-resident. He is coming to India. He is working in a German company, foreign company. He is coming to India for around 85 days. Sir, his salary will be exempt. We have seen some exemption under section 10(6). No. We have seen some exemption under section 10(6) like this. But his salary, Mr. Charles' salary will not be exempt. Why? Because the condition for exemption was the foreign company should not do any trade or business in India and the foreign company should not claim that as an expense in India, should not charge that salary of 28 lakh rupees as an expense in India. Now, in this case, the foreign company is having a business in India because they are having a permanent establishment in India. That itself justifies that the foreign company has a business in India. At the same time, the foreign company is charging that expense in India. Therefore, this 28 lakh rupees will be taxable in the hands of Mr. Charles. Therefore, Mr. Charles will be liable to pay tax on this 28 lakh rupees. Yes, he can definitely claim what? 50,000 rupees standard deduction if he follows old regime, and if he follows new regime, then he can claim 75,000 standard deduction. I hope it is clear to all of you. Next one. The second income which is earned by the non-resident. Charles is holding some 1200 shares of an Indian company which was purchased in 2017 at 15 rupees per share. These shares were purchased in foreign currency. Okay. Now he is selling all these shares. Okay. He sold all the shares on 23rd of June 2024. So now non-resident is purchasing the shares of Indian company in foreign currency. So you have to apply the first proviso to section 48. You have to convert the you have to apply rule 115A. What will you do? First of all, you will convert the sale consideration and expense on transfer into foreign currency. Then you will convert the cost of acquisition into foreign currency. And then you will convert the capital gains again back into Indian currency. So what rate we will take? For converting the sale consideration and expense on transfer, you will take average of TTBR and TTSR on the date of transfer. For converting the cost of acquisition into Indian rupees into foreign currency, you will take average of TTBR and TTSR on the date of purchase. And then when you convert back into rupees, when you convert back the foreign currency long-term capital gains into rupees, then you will take only TTBR, not average. When you reconvert into rupees, you will take only TTBR on the date of transfer. I hope it is clear to all of you. All those things are given over here. You can take the data from here. The third thing which the Charles has done. The Charles is holding some 2000 shares in a foreign company. That is a foreign German company. Now, in which he acquired 145 rupees 2020. AG follows April to March as a financial account. Now, Charles is a non-resident. That AG Aarish GmbH is also a non-resident. So Charles is selling the shares of a foreign company. Now that will be only accrued in one case if it falls under Vodafone case. When the shares of Aarish GmbH derive its value substantially from asset located in India. And what do I mean by the shares of a foreign company derive its value substantially from asset located in India? When the shares of when the total asset in India of Aarish GmbH is at least 10 crore rupees. It is more than 10 crore rupees and it is at least 50% of the total assets. Okay. So in this case, the Charles will be liable to tax in India only under one circumstance. If Aarish GmbH shares derive its value substantially from asset located in India. For that, the first condition is the Indian asset has to be more than 10 crore rupees. Now, how much is the Indian asset? The properties held in India is only 8 crore rupees. This condition is violated. Therefore, the shares of Aarish GmbH does not derive its value substantially from asset located in India. Therefore, the income of Charles is not subject to tax in India. I hope it is clear to all of you. And the last and the fourth thing, the dividend from Aarish GmbH, dividend from foreign company, generally it is not taxable, but because it is received in India, this will be taxable in the hands of what? In the hands of Charles. I hope it is clear to all of you. So this was a beautiful question. Okay, beautiful question. Next question number 3 has two parts. Part number 1 is a theory question which talks about the authority for advance ruling has the power of compelling production of books of accounts. Is it true or not? Yes. The authority for advance ruling has all the powers covered under section 131, which is generally given to the income tax authority while issuing a summon. That is the power to inspect and discover, the power to compel production of books of accounts, which is mentioned over here, the power to enforce attendance, the power to issue commission. So the authority for advance ruling has all the powers which is generally given under the summons. Okay, so the same is the case over here. You can write all the 4 points over here. The next one is a question on equalization levy under 165A, which is removed by the Finance Act 2024 and also removed by the ICI from the syllabus. Therefore 165A equalization questions we are not going to do. Okay, I hope it is clear to all of you. Next one is a TDS question. Let's talk about the TDS applicability over here. We need to answer whether the TDS will be deducted or not. If yes, at what rate? If yes, if yes, at what rate? And if yes, then we have to deduct at what time? What is the timing? On the credit or payment, whichever is earlier, or at the time of payment, etc., etc., etc. First one, Indian company pays gross salary. How much gross salary? 7,30,000 to a general manager. Apart from that, the Indian company also pays non-monetary perquisites of 1,20,000. The manager is not opting for the 115 BAC. It means manager is opting for what? Manager is opting for old regime. Therefore, the old regime total income will come to how much? 8,50,000 is the salary, 50,000 standard deduction. The company will deduct TDS on 8 lakh rupees. When the company will deduct the TDS, the company will deduct the TDS on payment. Now, what is the rate of TDS? The rate of TDS is a slab rate as per the old regime. Okay, I hope it is clear to all of you. Next one, a notified infrastructure debt fund which is exempt under section 1047 is paying an interest of 5 lakh rupees. So how much TDS will be deducted? The TDS will be deducted under 194 LB at 5% plus 4%, which comes to 5.2%. Okay. Similarly, the expense deduction will not be allowed under the income tax law. 194 LB 1158 does not allow the deduction of expense. Therefore, the TDS will be deducted directly on how much? Directly on 5 lakh rupees. Plus. There is one more question in this. What will be your answer if the non-resident is located in NJ? If the non-resident is located in NJ, then you will not deduct TDS at 5.2%. Then you will deduct TDS at 30% plus 4%. That is 31.2%. I hope it is clear to all of you. Next one, which is talking about which I have told you in the class also. Suppose I tell you to make a shirt. Now you will ask me one question. Who will provide the material? I said that I will provide the material or my associated enterprise will provide the material. So if I will provide the material or if my associated entity provide the material, then what will happen? Then in that case, I have to deduct the TDS because then you are providing me service. Now in this also there are two views. First of all, if you give the breakup in the invoice, this much is for the material, this much is for the service, then I will deduct TDS on the service portion. But if you don't give the breakup, then I have to deduct TDS on the entire amount. Check it please. I hope it is clear to all of you. Next one, you are making some payment of 5 lakh rupees to a former Indian cricketer. So Indian cricketer for commentary in cricket match. So if you are giving some commentary or some payment to a commentator, then the commentator is nothing but a professional. Therefore, the TDS will be deducted under 194J at the rate of 10%. Okay, I hope it is clear. Next one is a very good question on section 263. What is section 263? Section 263 gives the power to the Commissioner of Income Tax to revise the order passed by the assessing officer. Generally, assessing officer passed the order. Now, later on, if the commissioner feels that, if the commissioner is of the opinion that the order passed by the AO is erroneous or prejudicial to the interest of revenue, then the commissioner has the power to revise that order. So, for that purpose, the commissioner issued a notice to what? To the assessing officer. Okay, now later on, and the proceeding was initiated. Later on, there was a survey on the assessee. Okay, now after the survey, the commissioner is issuing second notice to the assessing officer. So, and the content of the second notice is different from the content of the first notice. Therefore, the question is, can the commissioner issue a second notice where the content of the second notice is different from the content of the first notice? And the answer is no. The court said that the commissioner cannot do so. Okay. Next question. The Director General of Income Tax is in possession of certain cash, unaccounted cash. Now, by issuing an order under section 131, he is asking for seizure. Can he give an order of seizure under section 131? No. 131 is not for seizure. 131 is for summon. Therefore, if he wants to do seizure, then he has to pass a warrant under section 132. That power is not given under 131. That power is given under section 132 under search and seizure. Okay. With the help of 131, you can only do what? Summon. You can ask for inspection, discovery, etc. The four things which I have told you in previous question. Next question is a very simple question on DTAA. So I'm not going to do this question. It's a very simple question. We have done a similar question earlier, so let's not waste time on this. Okay, let's go ahead with the last question of this particular MTP. This is a good question. There is an NBFC. NBFC is depositing some money from its customer. So whether the 269SS and 269T provisions are applicable to NBFC, the answer is absolutely yes. 269SS and 269T provisions are not applicable to banking industry, are not applicable to post office, are not applicable to home, are not applicable to say cooperative bank, but it is definitely applicable to NBFCs. Okay, now this NBFC is receiving first 15,000 rupees on 1st May by bearer check. So that is allowed. Up to below 20,000 if you receive by other than account pay check, account pay draft, ECS and such other electronic mode, that is allowed. Okay, so it is 15,000 rupees now. Now next time you need to be very careful. Next time when you receive a cash, the aggregate amount should not be more than 20,000 rupees. So when you receive first time 15,000 rupees by bearer check, that is allowed because it is below 20,000. Now next time when you receive 15,000 rupees again on 30th June in cash, now you are gone. Now 269SS will attract because the aggregate amount which we have received now in cash and the outstanding amount earlier, both of them should also not be more than what? 20,000 rupees. So the how much we are receiving second time? 15,000. And what is the outstanding on the date of receiving cash loan? It was another 15,000. Therefore, the aggregate amount should not be more than equal to 20,000. Therefore, here 269SS will attract. Similarly, while repaying also we have to check under 269T. When we are repaying and if there is already a 20,000 rupees outstanding, we cannot pay a single rupee in cash. Okay. Now here, just check it please. Now you are making a repayment of 16,500 and bearer check. Do you already have a 20,000 or more outstanding in the name of that person? Yes, we have a 30,000 outstanding in the name of that person. Therefore, now you cannot repay a single rupee in cash. Therefore, this 16,000 rupee 500 paid will be subject to 269T and you will be liable for a penalty under 271E, which will be imposed by the Joint Commissioner. And under 269SS, the penalty will be imposed under 271D, again by the Joint Commissioner. Now, last, when you are repaying 15,500, what is the outstanding at that time? The outstanding at that time was 15,500 only. So that you can pay in what? That you can pay in cash. Okay, I hope it is clear to all of you. So here 269T will not attract. So this is what your first MTP is all about. So let's go ahead with the next MTP, MTP series 2, November 2023. Now the very first question over here is on partnership firm. Now let me read the last line what they want. They want total income under the normal provision. They don't want AMT. Okay, under the normal provision they don't want AMT. Just compute total income as per the normal provision. Therefore, in case of a partnership firm, what is the first thing that we compute? That is the first thing that we compute is the book profit. Okay, always try to compute the book profit first. What is book profit? Book profit for computing the remuneration as per section 40B. And what is book profit? Book profit is nothing but PGBP income only. You compute PGBP income and add back what? Add back your remuneration if debited to PNL. Be very careful. If debited to PNL, you have to add back the remuneration. Okay, I hope it is clear to all of you. Now pay attention please, all of you. Let's start with the computation of book profit. What is book profit, sir? 80 lakhs is your net profit. Now, in that, I will first of all add back interest on capital 13%. So, only 12% is allowed. Therefore, 1% I will add back. Okay, 1% add back. Loan taken from partner 15%. Only 12% is allowed. Therefore, 3% interest on loan I will add back. Okay. Interest on fixed deposit out of surplus fund 35,000. I will reduce from here and I will show under what? I will show under IFOS. Okay. Then depreciation as per books of accounts I will add back. Now, the next adjustment is a very, very beautiful adjustment. In 2020, you have purchased a building. The WDV of the building today is 36.45 and you sold that building for 90 lakh rupees. Okay. Now, so you are selling the building for 90 lakh rupees and that was the only asset in the block. So now you are selling the entire block. Therefore, short-term capital gain will arise. Correct. Now, what is the sale consideration of the block of the building? 90 lakhs. And what is the WDV? 36.45. Therefore, whatever is the differential amount, that will be subject to short-term capital gains because that is the only asset in the block. And because you are selling the only asset in the block, your block has become ceased to exist. Therefore, you will be liable for short-term capital gains. Therefore, this amount will be subject to what? Tax. So, what is the first effect? 90 minus 36, whatever it comes to 53.55. First of all, reduce that from PGBP because it is written in the question that it is credited in the PNL. Reduce that from PGBP and show that under capital gains. Now, when did you sell this? You sold on 10th of October. Now, within 6 months from the date of transfer, see, you have invested in the bond specified in NHAI. How much? On 5th of April 2025, you have invested 60 lakh rupees. Okay. Even though the bonds were issued later, but the date on which you invested is more important than the date on which the bonds were issued. The bonds were issued when? That is not relevant. The date on which you have invested in the bond, that is relevant. So, just try to understand from 10th of October 2024 to the date of investment 5th of April 2025, are we investing within 6 months? The answer is yes. The answer is yes, we are investing within 6 months. Therefore, you will get 50 lakh exemption from here, okay, from the short-term capital gains. From the short-term capital gains of building, you will get 50 lakh rupees exemption because maximum 50 lakh is only allowed under 54 EC. Now you will have one question in your mind. Sir, that is a block of asset, na? That is short-term capital gain. How can you claim short-term capital gains against 54 EC? 54 EC is only for long-term. It's wrong. 54 EC does not specify the nature of gain. 54 EC talks about the nature of asset. If the asset is long-term, then 54 EC is allowed, irrespective of whether the nature of gain is long-term or short-term. Okay, that is what it is written in the case of Ace Builders Limited. Did you all remember this case or not? Please comment and say me. Next one, I hope it is clear too. So ultimate treatment is 90 minus 36.45 SCCG minus 50 lakh rupees will be your ultimate capital gains on you will pay tax. Okay, next one, there are only two working partners. And there are you are paying 20,000 rupees per month to them. Remuneration is not debited to PNL. So because it is not debited to PNL, you don't have to add back. Okay, because if it would have been debited, we would have added back. Correct? It is not debited, na? That's good, na? That's well and good. If it would have been debited to the PNL, we would have added back to compute the book profit. Next, point number B, I will do at the end. First, I want to compute the book profit. Okay, the depreciation as per income tax 14,000. You can take the deduction. WDV of the motor car which was purchased in 2020. Now remember, if you have purchased a motor car from 23rd of August 2019 to 31st of March 2020, then you get a depreciation of extra 15%. So 15 plus 15 will come to how much? Will come to 30%. You will get 30% depreciation over here. Cost of mobile phones you have purchased in the current year in the month of October. It is used for less than 180 days. Therefore, you will take 50% of 15%. That is 7.5%. Okay. And last, now you will compute your what? Book profit. Now, after computing the book profit, you will get what? You will get your total book profit and then you will get the maximum remuneration. The book profit is 25,79,150. On first 6 lakhs, it is 90% and on balance, it is 60%. Therefore, the ultimate amount is going to come 17,27,490 is the maximum remuneration that the firm can allow, but actual remuneration is very low. It is 20,000 rupees per partner to only two working partners. Therefore, that will be 20,000 rupees per partner, two partners into 12, that will be 4,80,000. Therefore, you will get maximum deduction of only 4,80,000 rupees. I hope it is clear to all of you. At last, what you are going to do? You are going to claim the deduction under 10AA because you have applied for what? You have taken the approval before 31st March 2020. So remember, generally if you start a unit after 31st March 2021, deduction under 10AA is not available because the deduction expired on 31st March 2020. But in this case, because of COVID, I have told you in the class, if you have taken the letter of approval till 31st March 2020, then you can start the unit up to 31st March 2021 also. So in this case, the associate has taken the approval till 31st March 2020 and it has started the unit in before 31st March 2021. Therefore, it is eligible for deduction under 10AA also. The profit is 7.5 lakhs into what? Into export turnover, which is 40 lakhs, divided by total turnover, which is 120 lakhs. That will be subject to deduction. This is the 5th year of the business. Therefore, the assessee will be eligible for 100% deduction. I hope it is clear to all of you. Next question. Next question is question number 3. Question number 2, it's a printing mistake. Okay, so don't see the number over here. Okay, now this question is on exit tax. There's a trust which is on 31st Jan 2025. Now what has happened in this trust? The trust has made an application for registration in 2014. It got the registration in 2014 in July. It made the application in April. It got the registration in July. Okay, now the registration got cancelled on 31st of Jan 2025. Therefore, the trust will be liable for exit tax. For exit tax, we need to compute the accredited income of the trust, and on that we are going to apply what? We are going to apply MMR, that is 34.944% tax. Okay, so what is accredited income? For accredited income, you have to take all the assets of the trust minus all the liabilities of the trust. The very first asset is land. Am I going to take this in the accredited income? The answer is no. Why? Because this is purchased in 2011. Any asset which is purchased and any liability which is incurred before the registration should not be taken in the accredited income. Now, because this asset is purchased before the registration of 2014, therefore don't take this. Okay. For land and building purchased in 2018, yes, you will take that. For that, what value you will take? You will take market value or stamp duty value, whichever is higher. They have given us market value as how much? Market value 1,000 lakhs. Stamp duty value 1050, therefore take whichever is higher, that is 1050. Next. For equity shares listed, you will take what? You will take average of highest and the lowest price in the stock market. So you will take average of 1099, 1051 divided by 2. That will be the into 2000 shares. That will be the market value. That will be the value under what? For the equity shares. For next. For bank, you will take the balance sheet value, book value. For bank, you will take the balance sheet value. For cash in hand, you will take the balance sheet value. For creditor, for TDS, you will not take, taxes are not taken in accredited income. And last but not least, for creditors, it is 335, but out of which 30 is contingent. You can see over here, it is contingent. It is provided on estimated basis for which no bills are received. Therefore, 30 rupees you will not take. Therefore, only 305 rupees you will take in the creditor. And then you will compute your accredited income, and on that you will apply 34.944% tax, and that will be your tax, exit tax. Okay, I hope it is clear to all of you. Next question is on what? Next question is on section 44C. There is a foreign company or a non-resident who has a branch in India. So how much head office expense they can claim in India? Okay, how much head office expense they can allocate in India? They can take, as per 44C, it is 5% of adjusted total income or amount allocated to the Indian branch, whichever is lower. So whatever amount is allocated to the Indian branch by the head office, or 5% of the adjusted total income, whichever is lower, that will be allowed as deduction. So let's see how to compute the adjusted total income. They have given us the net profit, which is after the following thing. So we need to add few things. Will we add the current year depreciation? No. Will we add the unabsorbed depreciation? Yes. For that, you need to know the provisions of 44C. I am just saying out of what is written in the law. Okay. So the current year depreciation is not added back. Unabsorbed depreciation is added back. Will you add the capital expenditure of family planning? Yes, capital expenditure of family planning is added back. Revenue expenditure of family planning is not added back. Okay. Next, scientific research. No, scientific research is not added back. Bradford losses. Yes, you have to add back. Chapter 6A. Yes, you have to add back. Head office expenses. Yes, you have to add back. Add back all these things to 28 lakh rupees and then take 5% of that. And after that, compare with the actual head office expense allocated to India, that is 120 lakhs. Whichever is lower will be allowed as deduction. I hope it is clear to all of you. Let's move ahead with the next question. Question number 4, which is on what? Which is a very, very simple question on board for advance ruling. So there is an assessee who has applied to board for advance ruling, and the board for advance ruling has passed an order. Now the question is the order binding on the applicant? The answer is no. It is not binding. You have an option to file an appeal to High Court within 60 days from the date of receipt of an order. And in genuine cases, you will also get an extension of another 30 days. If you show a reasonable cause, you will get an extension of 30 days. So moral of the story, it is not binding on anybody. Okay. Next one, there is an Indian public sector company who wants to go for advance ruling, but their case is already pending before ITAT. Can they go for advance ruling? The answer is yes. Generally, if your case is pending in front of income tax authority or ITAT or court, you cannot go for advance ruling. But for public sector undertaking, there is an exception where it is said that in case of a public sector undertaking, they can go to ITAT even if their case is what? If their case is pending in front of income tax authority or ITAT. So in this case, the public sector company can go for what? Advance ruling. I hope it is clear to all of you. Next question, question number 5. Part A is a theory portion. You can see that question. Part B is a beautiful question. So let me explain that very beautifully to you all. It's a beautiful question. Part B, it's a very, very important question. At least 4 to 5 times they have asked this particular question in the exam. So you have to be very careful. Mark down this particular thing in your book. It's a very important question. There is an assessee by the name called as Toll Limited. Toll Limited is in India, be very careful. And Tick Limited is in Australia. And both of them are associate enterprise because Tick Limited holds 30% equity shares in Toll Limited. Therefore, both of them are deemed to be what? Both of sound is not coming. Who says? Hello, 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 hello. It's coming. Issue at your end, Gaurav. So, Toll Limited and Tick Limited are what? Are associate enterprise. Now, Toll Limited is providing some services to Toll Limited is providing some services to Tick Limited, and we need to find out what the arm's length price as per what? As per the cost plus method. Now, what is the first step in the cost plus method? The first step in the cost plus method is what is the direct and indirect cost with respect to the services provided to what? Associate enterprise. So whatever services I am providing to Tick Limited, what is the direct and indirect cost of that? The direct and indirect cost of that is 3,50,000 rupees. That is the first step that we need to find out. What is the second step? The second step is to find out the normal GP margin on cost. The normal GP margin with unrelated party, the third party, that is the uncontrolled transaction, that is the comparable, is 40%. Now, we need to compare our transaction with the third party transaction, and then we need to see the difference between the two functional differences, and then we need to adjust the functional differences in what? In this GP margin. Remember, in cost plus method, you adjust the GP margin. You do not adjust the price. You adjust the GP margin, and the revised GP margin will be added on the cost. Okay, that will give you the arm's length price. Therefore, in this case, there are 4 differences between our price and the price of the third party. So this is the normal GP margin. Now we need to adjust on this. Okay. Now, Toll Limited, all the 4 adjustments are beautiful adjustments. Toll Limited derives technological support from Tick Limited. Okay. So when I provide services to my associate enterprise, they also give me some services. Okay. There is no such support from the GN Limited. So the third party does not give me any support. So my associate enterprise When I provide him some services, they also give me some services. But the third party does not provide me any services. So I should charge more to my associate enterprise or less to my associate enterprise? Obviously less, because when I provide services to my associate enterprise, they also give me something in return now. So therefore I have to charge less to them. How much less? That amounts to normally 15% of normal GP. What is normal GP? It is 40%. So 15% of 40% comes to 6%. So I have to reduce my GP margin by 6%. So 40% I will reduce by 6%. That will come to 34%. Okay. Second adjustment. Now, as a Tick Limited gives business in large volume. So Tick Limited, my associate enterprise, gives me business in large volume. Therefore, I am giving him quantity discount, which I am not giving to third party. Okay, third party I am not giving any discount. So if the third party I am not giving any discount, then obviously to third party I will charge more, and there will be more GP margin. And to my associate enterprise I will charge less because I am giving discount. So there will be less GP margin. So this also have to reduce. That is also 10% of normal GP. 10% of normal GP comes to 4%. So that also will be reduced from here. So that will come to how much? That will come to now 30%. 40 minus 6 minus 4. Now we have reached till 30%. Okay. Third one. In rendering services to Tick Limited, Toll Limited neither runs any risk nor runs any nor incurs any marketing cost. On the other hand, when services are given to G&T, they are assumed to have risk and costs which are associated with marketing function, which is estimated 20% normal GP, which amounts to 8%. So remember, when I provide services to third party, there is lot of risk. There is lot of marketing. Therefore, if there is higher rate, there has to be higher return. But when I provide services to my associate enterprise, there is no risk. If there is no risk, then my profit in case of my GP margin in case of my associate enterprise has to be lower. Therefore, I am going from higher GP to lower GP, because when I provide services to my associate, a third party, there is a higher risk. Higher risk means higher profit. When I provide services to my associate enterprise, there is a lower risk. Lower risk means lower profit. Therefore, I have to reduce against 8% over here. How did I get 8%? 20% of normal GP, that is 20% of 40% comes to 8%. So I will reduce 8% over here. And the last one, Toll Limited offered 1 month credit to Tick Limited. So now when I provide services to my associate enterprise, I give 1 month credit. To others, I don't give any credit. So if I give credit to my associate enterprise, will I charge more profit or less profit? I will charge more profit. I will also ask for the credit now, which I am giving extra cost of credit, I will recover from you. Therefore, I will add back over here. Okay. So here I am going to not reduce, here I am going to add back. So after that, 5% of normal GP, that comes to 2%. So 2% I will add back. Whatever the arm's length GP will come, that will be the arm's length GP. That I will add on what? On 3,50,000 rupees, and therefore I will get what? I will get my arm's length price. I hope it is clear to all of you. Let's start with the next MTP. MTP Series 1, May 2024. Now it's a beautiful question. Sheetal Limited is a listed company. It has a books of accounts separately maintained for different unit. Its head office maintain books of accounts. Let me read the last line of the Sheetal Limited. We are supposed to compute total income of Sheetal Limited and optimum tax liability. Optimum tax liability. Okay. Assume the company has not yet opted for concessional tax regime. You must give the reason, blah, 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 blah. So, see. It's a very good question. There are multiple calculations that we are supposed to do over here. First of all, listen carefully. Sheetal Limited is what? Sheetal Limited, we need to compute the total income, tax liability, but optimum tax liability. So, we need to make 3 calculations over here. First, we will compute tax as per the normal regime, and then we will compute tax as per book profit. Check. They have also given us book profit over here. Okay, Matt. Okay, so when we compute the tax as per normal regime, we will compute normal tax and book profit, whichever is higher, that will be our first tax. Then we will check whether the assessee is eligible for 115 BAA or BAB, whatever is more beneficial to the assessee, whatever is applicable to the assessee, we will compute tax as per the special regime. Okay, first normal regime. In normal regime, we will make 2 calculations, normal and MAT, and in special regime, we will make 1 calculation, 115 BAA or BAB. And then we will see where the tax is coming lower. That is the best option. Okay, is it clear to everyone? So first we are computing the sum as per the normal regime. Okay, now the assessee is engaged in 4 different businesses. For them, they keep separate books of accounts. Okay, the first business is of chemical manufacturing unit in Jaipur. Okay, the net profit is 300 lakhs. Now they have entered into an agreement for use of know-how from a renowned scientist, for which they have paid a royalty of 40 lakh rupees. Okay, so royalty is allowed as reduction, but they have made a mistake. On 10 lakh rupees, they failed to deduct the TDS. And but they failed to deduct the TDS on 10 lakh rupees. But the payee has paid the tax. The payee has admitted the royalty income. The payee has filed the return. So in that case, what will happen? Nothing will happen. Still the expense will be disallowed only. Na? See, if I do not deduct your TDS, but if you include that in your income, and if you pay the tax, and if you file the return, then in that case, the government says that the payer is not an assessee in default, but the expense will be definitely disallowed in the current year, and in the next year, I will get the deduction. But in the current year, I have to disallow the expense. Therefore, 30% of the expense will be disallowed, assuming that we are paying it to the resident. Okay, I hope it is clear to all of you. Next one is you are paying 33,60,000 rupees as what? As employees notified pension scheme, which amounts to 15% of basic salary plus DN terms. Now remember, only 14% of basic salary in DN terms will be allowed. 15% will not be allowed. Therefore, you have to add back 1%. Okay, 1% will be add back. This will complete your first income. Okay, second, furniture manufacturing in Pune. You have a furniture manufacturing in Pune. Let's compute the income of this business. The net profit is 90 lakhs. The company has bought a trademark of 25 lakh rupees on 1st June. So that is not allowed as a deduction. That is allowed as a depreciation. So add back 25 lakhs and claim 25% depreciation on that. Then 3 lakh rupees you have paid as an interest to a non-resident Indian. The TDS was deducted in March and it was paid in May. So it is absolutely fine. You are deducting the TDS in the same year and you are paying before the due date of filing of return. So therefore this is allowed. There is nothing to be disallowed over here. Next, you are paying 7 lakh rupees as taxes on non-monetary perquisite of the employee. It is very specifically disallowed under section 40A5. Taxes of non-monetary perquisites of employees are disallowed under PGBP. So you will add back this. Okay, I hope it is clear to all of you. Let's move ahead with the third business. Fertilizer producing unit in Narmada. Remember, if you are engaged in production of fertilizer, then you are eligible for section 35AD deduction. So this is a special section. Okay, so if you are engaged in fertilizer, you are eligible for 35AD deduction. Now what is the profit? The net profit of the assessee is 220 lakhs, but this is after depreciation on building and plant and machinery. Now if you are claiming 35AD deduction, then you will not get deduction of depreciation, additional depreciation. So first of all, 220 lakh is the profit of the assessee. Add back both the depreciation, and then claim the deduction of building and plant and machinery directly 100%. Land you will not get deduction. Okay, building 2.5 crore you can claim deduction, and plant and machinery 3 crore you can claim deduction. Whatever loss will come over here, that loss you cannot set off against other business, because 35AD loss can set off only against 35AD business. It cannot set off against other businesses. Okay, so this you have to carry forward. I hope it is clear to all of you. Next one, warehousing facility of storage of edible oil. Whether storage of edible oil is also covered under 35AD? The answer is no. Edible oils are not covered under 35AD. Okay, only agriculture product and sugar is covered under 35AD. So this is the normal business. Okay, so what is the profit over here? Your profit is 70 lakh rupees without deducting depreciation. So claim depreciation on plant and machinery. On building you claim 10%, on plant and machinery you claim 5%, you claim depreciation and go ahead. Okay, so now this we have done all the four business. Now there are some additional information you have which has been given to you. The company mobilized capital during the year 24-25 by public issue of the shares. The money was kept in the bank pending allotment of share. The interest income from the said bank is credited to general. So absolutely correct. So if you have received share application money from the shareholder, and if you have put that money in the bank, on that you are earning some interest, then that is not considered to be IFO's income. Okay, there is a High Court judgment on that. Rama Multitech, I don't remember the exact name of the case law. That is not considered to be an IFO's income. That has to be credited to the PNL or general reserve. The company has done correctly. Okay. Next, the company has also received 56 lakhs as dividend. So that will go under IFO's. And the company has distributed 40 lakh as dividend. So that company can claim as a deduction under ATM, because whichever is lower, dividend received or dividend distributed, whichever is lower, that can be claimed as a deduction under ATM. Okay. Now, the turnover of the company of last year is 390 crore. Therefore, the company will be subject to 25% tax plus surcharge if applicable. I don't know the exact total income. If the total income exceeds the limit, then you have to apply surcharge also. So that will complete your first tax. Okay. Now we will compute the book profit. Book profit they have directly given us 520 lakhs. So on 520 lakhs, we will directly compute tax. How much? 15% MAT. 7% surcharge, because the book profit is more than 1 crore rupees, and 4% cess. Okay, therefore this will be subject to second tax. Now compare both the tax. Whichever is higher, this will be your first tax. Okay, now we will go with the special tax regime, because we need to find out the optimum tax liability. So we need to find out the special tax regime also. Sir, what is which special tax regime assessee will follow? Assessee will follow 115BAA. BAB is not possible. Sir, why BAB is not possible? BAB is possible only for those assessees who are engaged in what? Who are engaged first of all in only one manufacturing business. All those who are engaged in multiple businesses are not eligible for 115BAB. 115BAB is only available if you are engaged in manufacturing business. Secondly, 115BAB is available only in the first year of the business. This is, you have not taken in the first year of business 115BAB, so in the second year you cannot take 115BAB. Therefore, you can go for 115BAA. So in 115BAA, how the things will change? only 3580 deduction will be disallowed to you. Okay, don't take 3580 deduction. Okay, 3580 deduction will not be allowed to you. Okay, in place of that, sir, what can I do? In place of 3580 deduction, what you can do is you can claim depreciation. That is, this depreciation you can claim. That's it. Apart from that, everything will be same, and the tax rate will be 22% tax, 10% surcharge, 4% cess. I hope it is clear to all of you. So this was a very, very, very good question. Beautiful question it was. The next question is also a beautiful question. This is one of the best MTPs. One of the best MTPs out of all the MTPs is this one. Now let's see. ABC Private Limited is there, which is converted into LLP. So if a private limited is converted into an LLP, say on 1st of October 2024, then the provisions of section 4713B are applicable. Okay. Provision of section 4713B are applicable. Now we need to give the implication of the following items. Business loss. What will happen with the business loss? Yes, the LLP can carry forward the business loss for another 8 years. Okay. Treatment number 1. Next, what will happen with the written down value of the asset? Now, plant and machinery 15%. Market value ignored. Take the WDV. Take the WDV of the plant and machinery, 14 lakhs into 15%. This 2,10,000 depreciation will be apportioned between both of them. Between the company and the LLP on the basis of number of days the assets are used by both of them. Okay. Third, plant and machinery 75 lakhs, 3580 deduction claim. For this, the actual cost in the hands of the LLP will be 0. Because any asset on which deduction under 3580 is claimed, the actual cost of that asset is 0, 0, 0. Even in case of conversion from a company to LLP, even the LLP cannot claim depreciation on that particular asset on which the company has taken deduction under 3580. Be very careful. It is written under explanation 13 to section 43(1). Next one, for building same thing. Both of them will claim depreciation. Okay, 40 lakhs. Don't take the market value. You have to take WDV in the hands of the preceding entity. That will be considered to be the actual cost in your hands. Take 40 lakhs into 10%, 4 lakhs, apportion between both of them. Okay. Now, whatever depreciation is claimed by the company, reduce that from the WDV, and the balance WDV will be given to the LLP, and the LLP in the future years will claim depreciation on that amount. Okay. Next one. The LLP has the company has purchased the land for 80 lakh rupees. The market value of the land is 120 lakhs. So that market value will 80 lakh rupees will become the cost in the hands of the LLP. The cost to the previous owner will become the cost, because as per section 49, where an asset is received by an LLP from a private company, in case of conversion, then the cost in the hands of the LLP will be the cost to the previous owner. Whatever is the cost in the hands of the previous owner, that will become the cost in the hands of the LLP. Okay. Next one, VRS expenses of 28 lakh rupees incurred in 22-23. So VRS is allowed in 5 equal years. So in the current year, entirely the LLP will claim. Entirely LLP will claim. Okay. Last 2 years, company was claiming. In future year, also LLP will claim. In the current year, entirely LLP will claim. Don't bifurcate based on number of days. VRS expenses are not divided based on number of days. Okay. MAT credit is not allowed to carry forward. Not allowed to carry forward. Unabsorbed depreciation you can carry forward for infinite number of years. Okay, that is allowed. Now the next question is a very simple question of DTAA. I'm not interested in that. We have done a similar question earlier. You can check it. Very, 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 very simple. It's a lollipop question. You can go through it once. Okay, I'm not much interested in that. I'm going ahead with the next question. Okay, it's a beautiful, beautiful MTP. Next question is on charitable trust. There is a charitable trust by the name called as Satwik Charitable Trust. They are selling one building for 4.2 lakhs. Therefore, selling price is 4.2 lakhs. What is the purchase price? The purchase price was 2.2 lakhs. Therefore, capital gains is 2 lakh rupees. Now, if a charitable trust wants to save this capital gains, they have one section, section 11, subsection 1A. What are they supposed to do? They are supposed to reinvest this net consideration into another asset. So, if they reinvest this if they reinvest this consideration, not for 2 crore, not 2 lakhs, it is 4.2 lakhs. If they reinvest the consideration, that is 4.2 lakhs, then entire 2 lakhs rupees will be exempt. But if they invest less than 4.2 lakhs, then proportionate will be exempt. But they are investing how much? They are investing 3 lakh rupees. Then how much will be exempt? Cost of new asset minus cost of old asset. What is cost of new asset? 3 lakhs. What is cost of old asset? 2 lakhs. This much will be exempt. Okay. So this much will be exempt. 2.2 lakhs. I'll just write down over here. Just a second. Pencil is not working. Cost of new asset 3 lakhs minus cost of old asset 2.2 lakhs. 80,000 will be exempt. Okay, that's what I am exempting over here, and the balance amount will be subject to tax. Again, I am saying if they want to exempt entire 2 lakhs rupees, then they have to invest the entire 4.2 lakhs. If they would have invested entire 4.2 lakhs in fixed deposit, then nothing would have been taxable over here. I hope it is clear to all of you. Next one. There is a religious trust as well as charitable trust, both, combination of both. They are maintaining 2 separate donation boxes. Now they are receiving anonymous donation. Some amount is received in temple, some amount is received in charitable purpose for school.
So whether 115 BBC will be applicable or not. See, I have told you, if a charitable trust is both charitable and religious trust, and if they maintain two separate donation boxes, then the amount received in the charitable donation box, that is in the temple, that will not be subject to 115 BBC, but the amount received in the school donation box, that will be subject to 115 BBC. Okay, I hope it is clear to all of you. Next one is a question on electoral trust, which they have also asked in what? In the past past paper also. We have done this particular question in May 2024 paper, but again I am doing it for you all because it is an important question. Okay, so there is an electoral trust which was formed in 2023. Last year it was formed, and this is the second year. 2024-25 is the second year. Now the total contribution received is 420 lakhs, and the surplus of last year is 18 lakh rupees, and the trust is incurring 8 lakh rupees for managing its affairs. Okay, so we need to find out what is the distributable surplus. See, there is a provision under 13B which says that in the first year a trust can distribute how much? 5% of the voluntary contribution, okay, or 5 lakh rupees, whichever is lower. 5% of the voluntary contribution or 5 lakh rupees, whichever is lower. In the second year it is 5% or 3 lakh, whichever is lower. Okay, so we are into the second year, we are not into the first year. The first year has gone. The first year was 23, this is 24. So we can only contribute how much? 3 lakh rupees maximum as a distributor, as we can only incur maximum 3 lakh rupees to manage the affairs of the trust. Okay, so how much you are incurring to manage the affairs of the trust? 8 lakh rupees. You are not allowed to do that. You are allowed to do only 3 lakh rupees. Therefore, total how much money you have? 420 plus 18, that comes to 438. Out of which how much you are allowed to maximum incur for managing the affairs of the trust? Only 3 lakh rupees. Therefore, the distributable surplus is 435 lakhs. Okay, that is the answer. Now we need to check one more thing. We need to also claim exemption. To claim exemption, we need to check that whatever amount we have received in the current year plus whatever amount we have received in the last year, aggregate of both of them, 95% has to be distributed. So 95% of 438 comes to 416.1. So therefore that is okay. So if I distribute 435 rupees, it's okay. It is within the limit. It is within the limit of the managing of affairs also, and it is above the limit of what? 95% also. It cannot go below 95%. Now, if it goes below 95%, then you will lose the exemption. So it has to be above 95% also, and it has to be limit as per the managing the affairs expenses also. I hope it is clear to all of you. Next one is a very, very simple question on transfer pricing. Trax INC is a foreign company. Is an Indian company. Olive INC is a foreign company. One entity guarantees another 12% of the total borrowing. So if one entity guarantees another entity 10% or more of the total borrowing, then both of them are deemed to be associate enterprise. Therefore, both of them are deemed to be associate enterprise. Now, second part says that suppose the assessing officer has made a primary adjustment of previous year 22-23 on 31st March 2024, and it is accepted by Trax and INC. So, what are the implications? So, if on 31st March 2024, AO has done a primary adjustment of 310 lakhs, which is more than 1 crore rupees. Therefore, it is the obligation of the assessee to bring back that money in India within 90 days from the date on which the order was passed by the assessing officer. So, the assessee has to bring back that money, 310 lakhs to India within 90 days from 31st March 2024. If the assessee does not do that, then what will happen? What will happen if the assessee does not do this? If the assessee does not do this, then secondary adjustment will apply. How secondary adjustment will be applied? We need to compute the tax. We need to compute the interest on 310 lakhs. What will be the interest? You will take SBI's MCLR 9% plus 3.25%, and you will compute the interest for the entire year. Okay, from 1st April to 31st March 2025. One more option you have. You have one more option that you pay one-time additional tax of 20.9664. If you pay that, you will be relieved from the next year. Okay, from the date of payment of that tax, you will be relieved. Okay, after that, no secondary adjustment will be imposed on you. It's a very, very big paper. Next one. And it's a very dangerous paper also. Next one. Question number 4. There is a company who is doing a business. Check here. Trading business. And the last year turnover of the company is how much? 70 crore rupees. Now this company accepts from the customer only cash, check, credit card, debit card. They do not accept any other mode of payment. They only accept these 4 modes of payment. Can they do so? The answer is no. There is a section 269 SU and the penalty under 271 DB which says that if you are doing a business and if your last year turnover is more than 50 crore rupees, listen carefully. If you are doing a business and if your last year turnover is more than 50 crore rupees, then in that particular case, you have to keep the prescribed mode of payment in your business. And if you don't keep the prescribed mode of payment like Bheem UPI, RuPay debit card, then the QR code, etc., then there will be a penalty of 5,000 rupees per day till the time you don't install those mode of payment in your business. I hope it is clear to all of you. Next one, there is a tax assessment on Mr. Raghav which was completed on 25th of December and the tax due was 28 lakh rupees. Now the question is, from which all places the AO can recover this? The AO can recover from whatever assets belong to Mr. Raghav, or whatever assets Mr. Raghav has given to somebody else and whose income is clubbed in the hands of Mr. Raghav. Be very careful. Whatever assets belong to Mr. Raghav, the AO can recover from them, and whatever assets the Raghav has given to somebody for which the income is clubbed in the hands of Raghav, the department can club, the department can recover from there also. First of all, Raghav has a bank deposit with Canara Bank, so from here the department can recover obviously. Raghav has a receivable, that is debtors. So the department can recover from the debtors also. Now the third one is important. Raghav has gifted a land to his major son. So whether a land which is gifted to a major son, whether the income of that land is also clubbed in the hands of the father, the answer is no. Only the income of minor is clubbed in the hand of father. Income of major son is not clubbed in the hands of father. Therefore, this particular amount cannot be recovered by the department. Next, you are giving some diamond necklace to your son's wife. Whether that will also be clubbed? The answer is yes. If you give anything to your son's wife, that is clubbed under the income tax provision under section 60 to 65. You can go and revisit your CA inter books. When you give something to your son's wife, that is also clubbed in the hands of father-in-law or mother-in-law. So this the department can recover. Okay, diamond necklace. And last, Raghav has a residential apartment in Australia. Definitely the department can recover from there also. Okay, I hope it is clear to all of you. The next question is a beautiful question of Vodafone case law. Vodafone case law. So to explain this particular question, I have made one small chart below. You can just try to understand this chart first. Okay, there is an Indian company, and Flix Inc. is a foreign company which holds 100% in the Indian company. Okay, Flix Inc. is a foreign company, and Angelo is a non-resident, James is a non-resident. Both of them holds 50% in the Flix Inc. Now, Angelo holds 50%, James holds 50%. They are selling the shares of Flix Inc. Whether the shares sold by Angelo and James of Flix Inc., whether they will be deemed to accrue or rise in India, whether the shares of Flix Inc. sold, whether that will be chargeable to tax in India, that will be depending upon only one factor. If the shares of Flix Inc. derive its value substantially from asset located in India, if the shares of a foreign company derive its value substantially from Vodafone case law, if the shares of Flix Inc. derive its value substantially from asset located in India, then it is deemed to accrue or rise in India. So what do I mean by substantially from asset located in India? Two conditions have to be fulfilled by Flix Inc. First, the Indian assets of Flix Inc. has to be more than 10 crore rupees. Second, the Indian assets of the Flix Inc. has to be at least 50% of the total assets. If these two conditions are fulfilled by Flix Inc., the shares of Flix Inc. are deemed to accrue or rise in India. Then whether Angelo sells, James sells, the income will be accrued in India. So on which date we are supposed to check this 10 crore and 50%? You are supposed to check this 10 crore and 50% on a specified date. So what is specified date? The specified date can be generally two dates. It can be the last balance sheet date, or it can be the date of transfer. What is the date of transfer? The date of transfer is 1st June. What is the last balance sheet date? The last balance sheet date of Flix Inc. is 31st December. Be very careful. Be very careful. The last balance sheet date or date of transfer. Generally, you should take last balance sheet date. That should be the date, specified date. But if the difference in the book value from the last balance sheet date and the date of transfer is more than 15%, then you should take the specified date as date of transfer. So first of all, we will see the book value on the last balance sheet date. The book value on the last balance sheet date is 1000 crores. Now, you should also check the book value on the date of transfer. The book value on the date of transfer is 1300 crore. Is the difference between the two more than 15%? Yes. Then you cannot take the balance sheet date as the specified date. Then you have to take 1st June date of transfer as specified date. If the difference would have been less than 15%, then I would have taken 31st December as my specified date. But in this case, the difference between the last balance sheet date and the date of transfer, the book value of the asset is more than 15%. Therefore, you will take the value on that is the specified date will be 1st June 2023. And now on 1st June 2023, you will check whether the fair market value of the asset, while computing the value of 10 crore or 50%, now you will not check book value. Now you will check the fair market value of the asset without reduction of liability. So now you will check whether the Indian assets. So first you have to find out the specified date. So for finding out specified date, take always book value, and once specified date is found, then you will find out what the 10 crore or and 50% is computed, is properly fulfilled or not. So let's check now. we have computed the specified date. The specified date is 1st June 2024. That is the date of transfer, because the difference is more than 15%. So now, what is the Indian asset? The Indian asset is 600 crore. You can check over here. And what is the total asset? So therefore, is the Indian asset more than 10 crore? The answer is yes, it is 600 crore. And what is the percentage of Indian assets as compared to the total asset? It is 600 crore divided by total assets of Flex Science is 1100 crore. Therefore, that is 54.45. Therefore, both the conditions are fulfilled on specified date. Therefore, the income of Flex Science, the Flex Science derive its value substantially from asset located in India. Therefore, the shares which are held by James and Angelo, if they sell the shares, that will be deemed to accrue or arise in India. I hope it is clear to all of you. It is a beautiful question. And one last question, I guess, over here is this one. Shall I read this question? Please tell me. There is one. There are two categories. There are two small questions over here. We need to find out whether GAR will be applied or not. First case, there is an assessee who has two units. One is in SEZ, one is in non-SEZ. Now, the non-SEZ unit is doing what? The non-SEZ unit is doing manufacturing, and SEZ unit is doing only packing. Again, I am saying SEZ unit is doing only packing. Therefore, will it be eligible for what? Will it be eligible for deduction? No, it's a clear case of tax evasion, and because it's a clear case of tax evasion, therefore GAR will not apply. GAR does not apply if there is a tax evasion. GAR does not apply if there is a tax planning. GAR does not apply if there is a specific anti-avoidance rule. GAR applies if there is a tax avoidance. Okay, so this is a clear case of tax evasion, therefore GAR will not apply. Second case, there is an Indian company which has two units. How many units? Two units. Now, one is in SEZ, one is in non-SEZ. Now they are trying to transfer the goods within themselves at a higher price, lower price, and trying to manipulate the deduction. It's a specific case of domestic transfer pricing. So here, specific anti-avoidance rule is applicable. We all know that if one unit is eligible for ATIA, ATIB, ATIC, and 10AA, and another unit is not eligible for ATIA, ATIB, 10AA, and if they do any transactions between themselves, then that is subject to what? Domestic transfer pricing. But there is one condition, that the aggregate amount of transaction should exceed how much? 20 crore rupees. Only then domestic transfer pricing is applicable. Otherwise, domestic transfer pricing is not applicable. Next one is a question on tax audit. So be very careful with this question. It's a beautiful question. There is a firm who has employed 30 new employees with a salary of 24,500, and that is paid by an account paycheck. In addition, the firm is also contributing 10% to the employer contribution, and the firm is paying transport allowance of 3,500 paid in cash. Okay, the gross total income of the firm includes PGBP income of 75 lakh rupees. Now, the firm has claimed deduction of 26 lakhs 46,000. That is 30 employees, 24,500 into 12 under 80 JJAA. The chartered accountant has also given a form under a report under form 10DA that the deduction is correctly computed. Okay, now the question over here is, the deduction under 80 JJAA is available if the emolument is what? If the emolument is up to 25,000 rupees. So now, what does emolument include? Emolument includes everything that is paid to a employee. First of all, it will include salary. Will it also include employer contribution to provident fund? No, that will not include employer contribution to provident fund, because that is specifically excluded. Third, will it include transport allowance? Definitely transport allowance will also be included. The chartered accountant has not considered transport allowances over here because it is paid in cash. How does it matter whether it is paid in cash or not? It doesn't matter. Whether it is paid in cash or whether it is not paid in cash, you have to consider both of them. And if I consider both of them, 24,500 plus 3,500, it amounts to 28,000. And if the emolument exceeds 25,000 rupees, you are not eligible for 80 JJAA. Therefore, in this case, the chartered accountant is guilty. The chartered accountant is guilty under part 1 of second schedule, and he will be facing the consequences from the ICAS disciplinary committee. Okay, I hope it is clear to all of you. And one last question over here is, which is similar to what we have done earlier, that there is a company which has gone to board for advance ruling, and the advance ruling has given its ruling. Is it binding? Absolutely, it is not binding. We have done this just now, half an hour before. It is not binding. It is not mandatory. You can go and file an appeal in High Court within 60 days from the date of receipt of order. And in case of genuine cases, you will also get an extension of 30 days. I hope it is clear to all of you. So this is what this beautiful MTP is all about. Let's go ahead with MTP Series 2 May 2024. Question number one. We are supposed to compute total income, tax liability, in a most beneficial manner. Again, they are asking us to compute tax liability in a most beneficial manner. Again, we are supposed to make three calculations. First, normal calculation, then 115 JB book profit, then we need to compute as per 115 BAA or 115 BAB as the case may be. So first I am computing as per the normal provision. So this is a domestic company which is engaged in manufacturing. It was set up in 2023. Okay, just now it has been set up. Now the profit is 1 crore 47 lakh. Depreciation you will add back, then lump sum consideration for obtaining design and know-how you will add back this, and then you will take 12.5% depreciation, 50% depreciation on intangible asset, that is 12.5 because the asset is used for less than 180 days. Okay, next you are purchasing something from your related party, then at 96 lakhs, whereas the market value is 82 lakhs, therefore the differential amount will be added back as what excess amount. Okay, next is a very important adjustment. You are receiving cash subsidy of 15 lakh rupees from the state government for new plant and machinery. So if you are receiving a subsidy, grant or reimbursement for fixed asset, you have to reduce from the block of asset. So you have to reduce that first of all from BGBP income. It is not an income. And then you will reduce from the machinery. The value of machinery you can see over here is 75 lakh. So I will reduce this subsidy from the 75 lakh rupees. I hope it is clear to all of you. Next one, bonus issue. If you are incur some expenses to issue bonus shares, that is allowed as deduction. But if you incur some expenses to issue right shares, that is not allowed as deduction. Next one, short-term capital gains on transfer of capital asset being equity shares on which STT is paid. So you will reduce from here. You will show under capital gains 111A 20% tax, assuming it is transferred on or after 23rd July. If it is transferred before 23rd July, then it will be subject to 15% tax. Depreciation, you can claim 36 lakhs as deduction, which is as per the income tax law. Then you are selling some unlisted shares for how much? For 22 lakh rupees. You have purchased the unlisted share for how much? 12 lakh rupees. Now you have purchased in this year only, so it is a short-term capital gains, and short-term capital gains of 10 lakhs will be taxed at normal rate because this is not a 111 short-term capital gain. This is the normal short-term capital gains. And last but not least, you are purchasing a machine of 75 lakh rupees on which you are paying 10 lakh rupees by bearer check, so that will not be subject to depreciation. Therefore, you have to reduce that from the actual cost. Therefore, eventually your actual cost will be only 50 lakh rupees. On that, you will claim 15% normal depreciation and 20% additional depreciation. Now you will compute your tax as per the normal provision. How much tax you will take? You will take 25% tax, sir. Why 25% tax? Because this is the first year of business. And in case of first year of business, your last to last year turnover is 0 rupees now. Therefore, you have to take 25% depreciation. You don't have any other option. Okay. Then apply surcharge if applicable and cess. Now you compute the book profit as per MAT. The book profit is 320 lakhs. So take 15% tax, 7% surcharge because the book profit is more than 1 crore, and 4% cess. Okay, I hope it is clear to all of you. Now you compute what? As per 115 BAA or BAB. Which section is applicable? See, 115 BAB you can take over here. Why, sir? Why? Because this is a domestic company and this is engaged in manufacturing, and this is the first year of business, and your business has to be commenced between 1st October 2019 to 31st March 2024. So you are commencing in this year, and this is also your first year of business, so you can claim 115 BAB. In 115 BAB, how much tax will be imposed? How much tax? On your manufacturing income, you will be paying tax at the rate of 15% tax. Okay. On your short-term capital gains of this short-term capital gains 111A, you will pay 20% tax. This short-term capital gains, which is taxed generally at normal rate, on this you will pay 22% tax. Okay. And then you will apply 10% surcharge and 4% cess. And in 115 BAB, there is only one difference. You will add additional depreciation. There is no other difference between the normal provision and 115 BAB. Just the additional depreciation which you are claiming now on this machinery of 50 lakh rupees, you have to add back that additional depreciation. I hope it is clear to all of you. Now, there are a lot of things which are repeated over here. So whatever is repeated, I am not going to do that with you all, because and only something which is 100% repeated, only that I am going to ignore. Even if one of the adjustment is same, I am going to do it with you all. Believe me. Even if one of the adjustment is same, now I will do it with you all. If the question is exactly similar, so I will not do that. See, these two questions we have already done in past papers or in past RTP. Check it please if you want. We have already done these questions, both of them. This is based on trust. Same question we have done earlier. Okay, so it doesn't make sense to repeat that once again. Okay, I'm going ahead with the next question. Now this is a beautiful question once again. Beautiful question on DTAA. I've told you, if there is some new question which comes on DTAA, I will definitely solve with you all. Now, Mr. Sarthak is an Indian citizen. He is 51 years old. He left India for the first time on 1st April 2021. Now, due to some unavoidable circumstances, he returned back to India on 1st of June 2024 permanently. So, what is his residential status? See, on 1st June 2024, he is coming to India permanently. So, therefore, he is definitely staying in India for 182 days. Therefore, he is resident. Now, he left India in 2021. So, therefore, in the last 10 years, He is definitely resident in 2 years. In the last 7 years also, he will fulfill 730 days condition. Therefore, 100% is resident and ordinary resident. Therefore, world income is taxable for Mr. Sarthak. Okay, I hope it is clear to all of you. Now, what is the first income that Mr. Sarthak will be computing? So, world income is taxable for Sarthak. First, Sarthak has a residential property in what? In country Y, from which he earns a rent of $3,200. Okay, so now on this $3,200, we have to convert that into rupees. How will you convert a foreign income into Indian income? For converting the house property income into Indian income or any foreign income into Indian income, you have to follow rule 115. So as per rule 115, if I want to convert this $32,000 into Indian rupees, I have to take TTBR on the last day of the financial year, and the last day of the financial year is 31st March 2025, and the TTBR is 75. So I will do 32,000 into 75. That will be 24 lakhs. On that, I will take 30% standard deduction, and this will be my house property income. I hope it is clear to all of you. Now next, what is the next income? The next income is 6,20,000 business income in India. That is in rupees. Directly write down. Next is dividend received from an Indian company. Now dividend received from an Indian company, you have to gross up. You have to gross up by taking at 2,25,000 is 90%. So 100% is how much? Gross up and show that. And then last but not least, 13,500 is interest on saving bank. So that will be IFRS income. On that you can claim 80 TTA, sorry, deduction you can claim. Mr. Sarthak is shifting out of default regime. Therefore, Mr. Sarthak is following old regime. Therefore, you can claim 80 TTA over here. I hope it is clear to all of you. After that, you compute the tax normally. And after computing the tax, you find out the average rate in India. Therefore, the tax over here is coming to 6,01,692. And the total income is 25,53,601,692 into 100. This will be our average rate in India, 23.56. The real game starts from here onwards. Now, we need to find out the average tax rate in India. What is the average tax rate in India? The average tax rate in India is 25%, but is eligible for 9,000 rupees exemption limit in the foreign country. Okay, so let's see what is the tax he has paid in the foreign country. So 32,000 is the total income in the foreign country, on which he will get 9,000 exemption. Therefore, he will be paying tax only on $23,000. 20% on $23,000 come to 4,600. Therefore, the average rate in foreign country is 4,600 is the tax, and the income is 32,000. Therefore, the average rate in foreign country is 14.375. Okay, I hope it is clear to all of you. 14.375 is the average rate. So therefore, whichever is lower, that you will apply on doubly tax income. What is doubly tax income? Doubly tax income is 16,80,000. So on 16,18,000, you will apply 14.375%, and therefore that amount will be subject to relief, and that much you will reduce from what? Your section 91 relief. I hope it is clear to all of you. So it was a beautiful question on DTAA. Let's go ahead with the next question. Question number 3, which is on TDS and TCS. The first question over here is, Mr. Amit is purchasing some scrap from Mr. Bharat. No. If Bharat is selling scrap, then Bharat should collect TCS under 206C subsection 1, subsection 1, subsection 1. Yes, but Amit is saying that I will be using this scrap for manufacturing, and he is giving a declaration to Bharat. So if you are giving that declaration to the seller, if the buyer is giving a declaration to the seller that I will be using it for what? I will be using it for what? Manufacturing, and I will not be using for what? Trading purpose. Then the seller will not collect TCS. But in that case, if the Amit's last year turnover is more than 10 crore rupees, then the Amit is liable to deduct TDS under 194Q. Remember or not? So if the seller is exempted from TCS, but if the buyer's last year turnover is more than 10 crore rupees, then the buyer will be liable to deduct TDS under 194Q. In this case, the last year turnover of Amit is more than 10 crore. Therefore, Amit will deduct TDS under 194Q. I hope it is clear to all of you. Next question is on real estate development. So I have a building, I gave you the building, you are a developer, and in return you are giving me some money. So whatever money you are paying to me on the date of agreement, monetary portion, you will give me two things. First, you will give me money, and then you will give me share in the project in future. Now, I am not interested in the share in the project for TDS purpose. I am interested in the money which you have given me. You have given me 6.5 crore rupees. So on 6.5 crore rupees, the builder will deduct TDS of the resident owner at the rate of 10% under 194 IC on the date of payment or date of credit, whichever is earlier. So on 6.5 crore, builder will deduct my TDS. Okay, I hope it is clear to all of you. Next one, there are two transactions in point number 3. First of all, the state government of Madhya Pradesh is giving a lease of coal mine. So I am state government of Madhya Pradesh. I am giving you what? A coal mine on lease. So if I am giving you a coal mine on lease, then I am supposed to, the Madhya Pradesh government will collect TCS from you at the rate of 2% under section 206C subsection 1C. Okay. So first of all, this transaction I will collect TCS at the rate of 2% on 206C1C on leasing transaction. Then you are extracting coal out of it, and then you are selling the coal to different people. So then The person who is selling the coal by extracting the coal, on sale of coal, I will collect TCS. Who will collect TCS? The seller, Maple Company. Now the government will not collect TCS. Government is not selling the coal. Government is giving only lease mine. So now Maple INC, Maple Company Limited will collect TCS under 206C subsection 1 at the rate of 1%. TCS on 1 crore rupees. I hope it is clear to all of you. Now, the next question, in this, we have done some of the question earlier, like, I'll tell you. This question we have done earlier, this question we have done earlier, so I'm not repeating that. The first question we have not done earlier, so I am doing that, okay? So there is a company which is incorporated in country M. It holds 1200 shares in PS Limited in Indian company since 2016. Now they have done some wrong things over here. Now, whether the GAR will be applicable or not? No, GAR will not apply. Why, sir? GAR does not apply to any transaction which has taken place on or before 1st of April 2017, because the provision of GAR came on 1st April 2017. Therefore, the transactions which are conducted before 1st April 2017, on that GAR will not be applicable. Therefore, GAR will not apply on this case. Now, this question we have done earlier, 100%. You can go and check the past paper. This question also we have done earlier in MTP, RTP earlier, 100%. I am giving reference also. Same as question number 6 of May 2024 paper, okay? Same question. You can go and check. This is the same question we have done in the tax audit earlier. Now, I am going ahead with the next question. There is a partnership firm. Now, this partnership firm is asking whether it is required to get the books of accounts audited. See, when a person is required to get the books of accounts audited, if it is doing a business, especially if it is engaged in the business of trading, business. When the turnover is more than 1 crore rupees, you are supposed to get the books of accounts audited. But for some people, it is 10 crore rupees. Who are those fortunate people for whom it is 10 crore rupees? If your cash receipt is up to 5% of total receipt and your cash payment is up to 5% of total payment. Now, let's see the cash receipt and cash payment of this entity. The cash receipt of this entity is 19 lakhs and the total receipt is 4 crore 50 lakhs, 56 lakhs. So, 19 divided by 456 come to 4.16. This condition is fulfilled. Second, what is the cash payment? Cash payment is 380. And what is the aggregate payment? Aggregate is 238. So 3.8 divided by 238 will come to 1.597. This condition is also fulfilled. Therefore, they are eligible they will be exempted from tax audit up to the turnover of 10 crore rupees. And the turnover of the associate is 2 crore 78 lakhs. Therefore, it is not eligible for what? It is not eligible for tax audit. And the next question also we have done earlier, just some time before, that if you are an Indian public sector company and if your case is pending in front of ITAD, can you go for what? Can you go for vote for advance ruling? The answer is yes. If your case is pending, in case of PSU, there is an exemption. Okay. I hope it is clear to all of you. So this is what this paper is all about. Is it clear, all of you? So let's go ahead with the next MTP series 1, November 2024. Very first question over here is, there is an individual who is doing a business whose last year turnover is 3.2 crore rupees. Now he is making some payment for repair of residential house of 3 lakh rupees. Whether 194C will apply? 194C does not apply for residential purpose. Whether 194M will apply? 194M will also not apply, because for application of 194M, your aggregate payment of the entire year should be more than 50 lakh rupees. Therefore, 194M is also not applicable in this case. Next, you are also paying 75,000 rupees to commission to Mr. Varun for business purpose. Whether 194H will apply? The answer is yes. The deductor, the payer is an individual. The last year business turnover is more than 1 crore rupees and you are paying more than 15,000 rupees commission. Therefore, TDS will be applicable over here at the rate of 2% from 1st October till 30th September. It was how much? It was 5%. From 1st October, it is 2%. Okay. I hope it is clear to all of you. Now, next one, you are taking a building on sublease. Along with that, you are also taking some machinery is also on sublease. Okay. Machinery also on lease. Okay. You are taking a business on, you are taking a building on lease. You are also taking a machinery on lease. So, rental TDS is deducted under 194I. So, when you see the limit of 194I, 2,40,000, you take aggregate limit of both of them. Is the aggregate limit of building, plant, machinery, furniture, etc. exceeding 2,40,000? If yes, you have to deduct the TDS. So, you are paying 20,000 rupees per month from 1st September for 7 months. That amounts to 1,40,000. And then you are paying from October 18,000 rupees per month for 6 months. That amounts to 1,08,000. The aggregate of both is going to be 2,48,000. Therefore, the TDS has to be deducted. Because for 194I, you have to check the aggregate limit of all of them, whether it exceeds 2,40,000 or not. Okay. Now, on building, you will deduct 10% TDS. On machinery, you will deduct how much? 2% TDS. Okay. I hope it is clear to all of you. Next one is a beautiful question. Beautiful question it is. Mr. Sarthak is a resident in India, aged 58 years. Okay. Now, he has an impressive mutual fund portfolio. very good mutual fund portfolio of crores of rupees. Now he redeemed his entire mutual fund and bought a villa in Gurugram. Now remember, if you are selling your assets and if there is a long-term capital asset and if you are buying a house, then you are eligible for section 54F, correct? So this is a classic case of 54F. You are selling your mutual funds, but if there is a long-term capital gains, then you are eligible for 54F. For short-term capital gains, you are not eligible for 54F. Now you have four different kind of mutual funds, out of which the first and the second fund are dead mutual funds. Sir, how did you come to know? You can read below. Fund 1 and 2 are investing 30% only in equity. So if there is less than 65% in equity, then it is a debt fund. Okay. If there is more than 65% is invested in the equity shares of domestic company, then it is an equity oriented fund. Now, in case of fund 3 and 4, you are investing 70% of the proceeds in the equity shares of domestic company. Therefore, fund 3 and 4 is equity oriented mutual fund. So first and second is debt oriented mutual fund. Third and fourth is equity oriented mutual fund. Now let's start. First one you have purchased in 2021 April and you are selling in 24 August. It means you are selling after what? After 24 months. Therefore, it is long term. Okay. So let's compute this. 1 crore 40 lakhs is the sale consideration. The cost of acquisition is 120 lakhs. This is long term capital gains. Sir, how it is long term capital gains? Is it not short term capital gains? Debt oriented mutual funds are always short term. No, it's not like that. It is only applicable. Section 50AA is not applicable in first case. Why, sir? In first case, section 50AA is not applicable. Not applicable. Why? Because that is only applicable if the debt mutual funds are purchased, are issued on or after 1st April 2023. Now, this mutual fund is issued on 2021. Therefore, to this mutual fund, 50AA is not applicable. So, this will be long-term capital gains. I hope it is clear to all of you. Okay. Second one is purchased in 2024 and sold in 2024 within 12 months. Therefore, it is a short-term capital gains. 50 minus 46. This will be subject to 4 lakh rupees short-term capital gains. This will not be subject to exemption also. This will be subject to exemption under 54F. Okay. Now, the third one and the fourth one is equity oriented fund. The third one is purchased in December 23 and sold in September 23. It is sold within 12 months. Therefore, it is short-term capital gains. Therefore, this is also short-term capital gains subject to 111A tax. Okay. Tax they are not asking. They are just asking the capital gains. And the fourth one is purchased in 2022, sold in 2024. Therefore, this is long-term capital gains. Here 50AA is not applicable because this is equity oriented fund, and therefore this will be subject to what? This will be subject to what? Exemption under section 54F. So first one will be subject to exemption under 54F. The fourth one will be subject to exemption under 54F. Second and third will not be subject to, because second and third are short-term capital gains. First and fourth are long-term capital gains. Now. How much is the capital gains in first one? 20 lakhs. What is the capital gains in fourth one? 10 lakhs. What is the total long-term capital gains? 30 lakhs. Now, if I want to save 30 lakhs, how much I am supposed to invest as per 54F? You know, I have to invest the entire consideration. 1 crore 40, 1 crore 20. Therefore, if I want to save this 10 plus 20, that is 30 lakh. I need to invest 140 plus 120, that is 260. But how much I am investing? I am investing only 2 crore rupees. Therefore, proportionate exemption I am going to get. I am not going to get full exemption. Okay. Now, let's see how much proportionate exemption. First fund, this fund, let's take full exemption in this fund and we will take proportionate in the previous one. So, 10 lakhs into what? Into 1 crore 20, that is the amount invested. I am exhausting the entire amount over here divided by net consideration. In the second capital gains, I am only exhausting the balance amount. So out of 2 crore, if I am exhausting 120 here itself, in the second case, I can exhaust 80 lakh rupees and the balance will be subject to tax. Okay. I hope it is clear to all of you. So this is what this question is all about. It was a beautiful question. Next question. The assessee received a draft order from the assessing officer as per 144C. Sir, what is 144C? 144C is a special section applicable to certain non-residents, foreign company and all those assessees for whom transfer pricing is applicable. Okay. So for them, the AO passed a draft order first and then the draft order is given to assessee and then the assessee has an option. Assessee has an option to accept the draft order or to object the draft order to DRP. If it objects to DRP, then the matter will go to DRP. If it accepts, then the AO will pass the order and then the assessee can go for appeal. So the question is it mandatory to go for DRP? The answer is no. Assessee has both the option. If the AO has given you the draft order, first option, you can go and object to DRP. Okay. Second option, you don't object to DRP, you accept that draft order and then you can go and appeal to CIT appeal. Both the options are available with you. It is not mandatory to what? Go for DRP. Okay. I hope it is clear to all of you. This is what it is written in this question. Next question is also a very, very small question, a beautiful question. Search was conducted and some gold bars were seized by the department. Okay. So department has done search at your premise. Some gold bars were seized from your place and now the assessee voluntarily goes and discloses the things and tells the assessing officer, see, you sell the gold bar and whatever is your tax liability, take the tax and give me the gold bar. it cannot happen like that. There is a provision in the law. You cannot go randomly and ask the department to sell the gold bar and take the tax liability and give me the remaining gold bar. It's not like that. The department does not work like that. See, first of all, there is a provision in the law which says that if during the course of search, if the department has seized something, you have an option that within 30 days from the end of the month, you can go to the department, explain the nature and the source of the particular item, and then the department will take the existing liability and will return back the remaining assets to you within 120 days from the date of search. This is the first thing. If you don't do this, then you have to wait for the assessment to complete. You cannot go in between and ask for the department to compute the tax and take the tax and take the gold and recover from the gold and give you the remaining gold. It is not possible. The only option is now to wait for the assessment to complete, let the liability be determined, and only then the assessing officer will return you the gold. Okay, I hope it is clear to all of you. Next question is a very simple question on equalization levy. There is an assessee and NI Limited, an Indian company. It wants to do some advertisement. So it is taking some advertisement services from a New York based company which does not have a permanent establishment in India, and you are paying 10 lakh rupees to that particular company. So if a foreign company who does not have a P in India and the Indian company is making the payment of more than 1 lakh rupees for online advertisement, then the Indian company should deduct equalization levy and pay the equalization levy at the rate of 6% by 7th of the following month. And if it does not do that, it will be liable for interest penalty. And if it does deduct and pay, then the foreign company will be exempt under section 1050. Apart from that, if the Indian company does not deduct the equalization levy and pay equalization levy, then the expense of 10 lakh rupees will also be disallowed under PGBP. I hope it is clear to all of you. Now there are two persons over here. Aryan and Aditya are two individuals. They are resident in India. Both of them are earning a salary of 13 lakh rupees. Now Aditya has paid an interest of 2,20,000 rupees on self-occupied property. Aryan has paid 25,000 rupees under Mediclaim, which is eligible under 80D. And Aditya has also contributed political party donation. Now we are supposed to compute which option is better for both of them. See, it is very simple. If you compute as per new regime, then you will get 13 lakhs minus 75,000 rupees standard deduction, and then you will compute the tax. Nothing will be allowed. House property deduction will not be allowed. 80D Mediclaim will not be allowed under new regime. 80C PPF will also not. Political party donation will also not be allowed if you follow the new regime. 13 lakhs minus 75,000, 12 lakh 25,000 compute tax on that as per the new regime. Second option, you can claim all the deductions, but in the old regime, your standard deduction of salary will be only 50,000. It will not be 75,000, and then the respective person can claim house property deduction. Its SOP interest of 2 lakh rupees, not 2 lakh 20. 80D you can claim 24,000, and donation to political party 1 lakh 50,000. You can claim that also, and check whichever is more beneficial. You can go for that option. Okay, I hope it is clear to all of you. Next question is a very simple question on transfer pricing. TI Limited has sold some goods to a person located in NJ. Now remember, whenever an Indian entity who sells any goods to, who enters into a transaction with a person located in NJ, then both of them are deemed to be associated enterprise. If an Indian entity enters into a transaction with a person located in NJ, it is deemed to be associated enterprise. You are selling to them at how much? 9.5 crore rupees. Therefore, the transaction between the Indian entity and the person located in NJ is international transaction. Transfer pricing is applicable. Now, you need to find out the comparable. To others, you sell at 10.5 crore and 11 crore. So, you have two arm's length price. So, compute two arm's length price. To others, you sell at 10.5 crore, 11 crore. So, you have two comparables. Okay. On that, you have to adjust two functional differences. One is of freight and insurance, another is of after sale support. After that, you will get two arm's length price. Now, because the number of arm's length price are less than 6, you will take arithmetic mean of both of them, and then you will compare with 9.5 crore, and whatever is the difference, you will add back. Generally, you check the difference has to be more than 3%. But in case of NJ, you don't get the benefit of that 3% tolerance limit also is not available to an NJ person. Okay, even if there is a difference of 1 rupee, that will be added back in the arm's length price. I hope it is clear to all of you. So this is what this MTP is all about. So let's go ahead with the next MTP, MTP Series 2, November 2024. This is our 6th MTP. There is a assessee whose name is SJ Industries Limited. If you read the last line, we are supposed to compute total income. We are supposed to compute total income as per normal provision. Do not follow 115 BAA and all. Okay. Just compute total income as per the normal provision. Let's start. Assessee is engaged in production and marketing. The profit is 72 lakh rupees. The depreciation as per income, as per Companies Act, is 24 lakhs. So you will add back that. Then next one is interest on short payment of advance tax. So advance tax is nothing but your income tax only. So on income tax, whatever interest you pay, that is disallowed under the income tax law. Next one, in your opening and closing stock, you are mistakenly including what? Borrowing cost, etc. in opening and closing stock. So in opening stock, if you are writing wrongly 9,50,000, so add back that. In closing stock, you are taking wrongly 7 lakh rupees, so reduce that from the credit side of the P&L. Next one, you are paying 41,000 rupees in cash. The breakup of that is as follows: 22,000 rupees you are paying to the producer of dairy farming. That is allowed as per Rule 6DD. If you pay in cash to a dairy farmer, it is allowed as per Rule 6DD. But 19,000 paid in cash towards printing and stationery, that is not allowed. More than 10,000 rupees you cannot pay in cash as per Section 40A3. Next is 3,50,000 you are paying to contractor, on which TDS is not deducted. So this will be disallowed. 30% will be disallowed under the income tax law because you are not deducting the TDS. Okay. Next, you have incurred 35,000 rupees towards expense earning from transfer of carbon credit. Remember, transfer of carbon credit income is taxable at 10% under 115 BBG, and expense incurred on that is not allowed as a deduction under the income tax law. Therefore, this will be disallowed. Contribution to electoral trust paid by check will be allowed. So you will disallow under PGBP and you will claim deduction under 80 GGB. Okay. Next, advertisement in a brochure of a political party, you will disallow under section 37(2)B under PGBP, but under chapter 6 under 80 GGB you can claim. Okay. Next. Interest on term loan taken from cooperative bank not paid. So whatever interest you have not paid, that will be disallowed, because interest from a cooperative bank is only allowed if it is paid as per 43B. Now because it is not paid, it is disallowed. Okay. Next one, pension of 1,50,000. Pension is allowed up to 14% of the salary. If you read the last line of the question, the salary and DA in terms of the company as per 80 CCD is 10 lakh rupees. Therefore 14% will be allowed of 10 lakh, that is 1,40,000 will be allowed. Therefore 10,000 will be disallowed in this particular case. Next one, you are receiving some unrealized rent of earlier years. Now unrealized rent received will be taxable in the year in which it is received. Now that will also be subject to 30% standard deduction. Now this point, hopeless point, they should not put. First of all, they remove house property from the syllabus. Yes or no? Now one student is asking, you are not feeling sleepy or not? No, I don't sleep till 3 or 4 o'clock. I sleep at 4 o'clock in the morning every day. That is my routine. Okay. I don't know why I don't get sleep, only because of the stress or something, because I don't know because of what. Coming to this, you can see in my eyes that there is no sleep. Okay. Even though it is almost 12 o'clock now. Now listen carefully, coming to the point. Unrealized rent, whenever it is received, it is taxable subject to 30% deduction. Institute has removed house property from the syllabus. Still they are putting such kind of adjustment. Hopeless people. Next one, dividend from foreign company. Reduce from here and show under IFRS. Dividend is IFRS income. Next one is a very intelligent adjustment. You have purchased, you have imported some machinery. On that there is a forex loss, okay, on payment. So whatever gain or loss is there on import of machinery on the date of payment is adjusted in the WDV of the asset. So this 3 lakh rupees you will adjust in the WDV of the asset. So WDV of the asset will be 95 lakhs is the cost of the asset. And because it is a gain, you will reduce. If it would have been loss, I would have added. Because it is a gain, I will reduce. Therefore my cost will be 92 lakhs. On this 92 lakhs, I will claim additional depreciation and normal depreciation. But both of them 50% because the machinery is put to use on 15 December. So on 92 lakhs, I will claim normal depreciation 7.5%, additional depreciation 10%. Okay. Next, interest from bank FD 10% TDS, net of TDS. Here I will reduce 135, and under IFRS I will show full 1,50,000 by grossing it up. Okay. Next, income tax depreciation 28 lakhs I will claim deduction. Next, last year I have taken a deduction of 35,000 rupees on accrual basis, but in the current year I made the payment in cash. That is wrong. So that is added to the income, that is deemed income. So in the last year, if you have claimed some expense on accrual basis, and in the current year, if you make the payment in cash, that is deemed to be income under section 48(3)(a). Last year audit fees I have not deducted the TDS, but in the current year I have deducted the TDS and paid. So therefore in the current year I will get the deduction of audit fees. Yes or no? In the last year audit fees would have been disallowed to the extent of 30%. So in the current year I will get 30% deduction. Next question, income from transfer of carbon credit. So transfer of carbon credit will be considered, it is already included in the net profit. So the ICI says that you can either show as an IFRS or you can either show as a PGBP income. It doesn't matter. Anyways, the tax will be same only. It is subject to 10% tax. So you can, if you want to show as an IFRS, then reduce from PGBP, show under IFRS. If you don't want to show as a PGBP, then show as a PGBP income, do not reduce. Okay. That's it. This is what this question is all about. I hope it is clear to all of you. Now, after this, most of the things in this paper are repeated. Most of the things. I'll tell you, I have given the reference also. First of all, this is a very simple DTAA question. We have done a similar question earlier. I'm not interested in this. Now, the next question is a good question. I need to see that. This not in the MTP, sorry, in the next MTP. In the May 2025 MTP, most of the things are repeated. Now, this is a good question. Let's see. Question number 3 on transfer pricing. Shall I start? Pay attention. STP Limited is an Indian company and Fixed Limited is a foreign company. And we have taken a loan of 60 crore rupees, out of which the STP is giving a guarantee of, Fixed Limited is giving a guarantee of 9 crore. Okay. So I am STP Limited in India, Fixed Limited is outside India, and I have taken a total borrowing of 60 crore rupees, out of which 9 crore guarantee is given by foreign company. So 9 crore divided by 60, that is greater than 10%. Therefore, if one entity gives a guarantee of more than 10% to another entity, more than equal to 10% to another entity, then both of them are deemed to be associate enterprise. Okay. So out of my total borrowing of 60 crores, 90 lakhs guarantee is given by what? Is given by my associate enterprise. Therefore, we both are associate enterprise. Now listen carefully. What is STP is doing? Listen carefully. STP is selling some cotton bed sheets at how much? It is selling at 2,200 to its associate enterprise, whereas to others it is selling at 2,300. So to my associate enterprise, I am selling at a cheaper price. To others, I am selling at higher price, that is 2,300. Therefore, I will start with what? I will start with my comparable price, that is 2,300. And now I will just see what is the functional difference between both of them. That's it. So to third party we sell at 2,300. So that will be the base point. From that amount we are going to start the discussion. Now, what is the functional difference between both of them? There is only one functional difference. The terms of the trades for other dealers was to make payment within 1 month. So STP gives 1 month credit to others, whereas to our associate enterprise it gives a credit of 3 months. So should I charge more or less to my associate enterprise? I should charge more because I am giving 2 months extra credit. Yes. To others, to third party I am giving 1 month credit. To my associate enterprise I am giving 3 months credit. So 2 months extra cost of capital I have to recover from you now. Therefore, I have to add back 2 months extra cost of capital. How will I get that? 2,300 into 2 by 12, extra 2 months extra cost of capital, 2 months extra opportunity I am going to take, opportunity loss I am going to recover from you. Into what? What is the rate of opportunity loss over here? Is 12%. Okay. So that I will add back, and that will give me what? My arm's length price. And then you have to compare with your actual price. Your actual price is how much? 2,200. And then you see how much is the difference. You have to add it back. And then we have to comment the same thing, that if the above transfer pricing is added suo motu by the SSE, then within how many times you have to bring back that money? That's the same old story you have to write about the secondary adjustment. I'll say it once again for you all. That is, if it is added suo motu by the SSE, then you have to bring back that money to India within 90 days from the due date of filing of return. If you don't bring back that money to India within 90 days from the due date of filing of return, then you have to charge interest as secondary adjustment. For that, you have to take SBI's MCLR on the first day of the previous year plus 3.25%. Now, one more option is there for you. That is, you can pay 20.966 for additional tax, and then you will be relieved from what? From secondary adjustment. I hope it is clear to all of you. Next one is a very simple question on TDS. You went to a bank, you are an LLP. Kite & Company is an LLP. You went to a bank and you have withdrawn 68 lakh rupees from first of all. And then you again withdraw 58 lakh rupees. You regularly file the income tax return. Okay. So if you regularly file the income tax return, then the bank will deduct TDS. If you withdraw more than 1 crore rupees in the entire year, on the excess amount, they will deduct 2% TDS. How much you are deducting? How much you are withdrawing? 126 lakhs. What is the excess amount? 26 lakhs. So on 26 lakhs, bank will deduct TDS at the rate of 2%. Now you will ask me one question. Sir, you are withdrawing for the purpose of buying agricultural produce from the farmer now. Sir, there is some exemption on that. There is no exemption on that. The exemption is not for this. The exemption is only available if Kite & Company is a commission agent. If he is a commission agent as per APMC market, if he is a commission agent and then if he withdraws from the bank to make payment to the farmers, only then he is exempted from TDS. Otherwise, normal assessee is not exempted from TDS for buying agricultural product. Okay, I hope it is clear to all of you. Next one, a non-resident individual is subscribing some capital gain bonds issued by Power Finance Corporation, and the Power Finance Corporation is giving interest of 98,000 rupees. So that is subject to tax. TDS will be deducted under section 195. I hope it is clear to all of you. Next one is a question. It's a beautiful question on what? It's a beautiful question on limitation of interest 94B. That is 30% of EBITDA, interest in excess of 30% of EBITDA, or amount of interest paid or payable to associate enterprise, whichever is lower will be disallowed. First of all, we need to prove whether the two entities are associate enterprise or not. XYZ Limited is Indian entity. Okay. Now, it is taking loan from L&T and Company. Okay. Now, SAM Limited holds 36% shares in XYZ Limited. Now, listen carefully. Therefore, SAM and XYZ are associate enterprise. Correct? Yes, both of them are associate. Now, the loan is given by L&T. Loan is given by L&T. And SAM is giving guarantee for the same. Check. So therefore, this interest will come under what? Limitation of interest. Why? Listen carefully. That if loan is given to me by third party, and if my associate enterprise loan is given to me by third party, who is third party? L&T. L&T is third party who is giving me loan, and my associate enterprise is giving guarantee. SAM is giving guarantee to L&T. Therefore, this is called as deemed dead. This is also subject to limitation of interest. Now, they have given us data of 2 years, 23-24, 24-25. First of all, we will compute for 23-24. For that, we need EBITDA. What is EBITDA? Earnings before interest, tax, depreciation, amortization. Now, this profit 2030. From that, I will reduce employee benefit expenses, that is salary, etc. I will get EBITDA, correct? Because I want a profit before interest, before depreciation, before tax now. So I will not reduce these things now, correct? So if I reduce 390, I will get EBITDA. Okay. Now I will compute the disallowance. What is disallowance? Interest, check on the board. Interest minus 30% of EBITDA, compare with interest payable, whichever is lower, that will be disallowed, and the balance interest will be allowed to you. Okay. This is as simple as that. Now the real catch is in the second year. Whatever interest is disallowed in the current year, as per this formula, that will be added to this interest. That is 389 next year. And next year EBITDA 30%. Whatever amounts come within the 30%, that will be allowed subject to this interest. For example, suppose the interest disallowed in the first year is 11 rupees. So I will add this 11 to this 389. Therefore, this will become 400. So in the second year, I am eligible to claim deduction up to 400 rupees. Now, in the second year, if the 30% of EBITDA comes to 390, then I can claim 389 of current year and 1 rupees of last year. In the second year, if the eligible amounts come to 30% comes to 400, then I can claim full 400, 389 plus 11 rupees. I hope it is clear to all of you. This is how you are going to compute the 94B limitation of interest. Okay. Now, let's go ahead with the next question. Yes, next question is on tax audit. There is a company by the name called as TMP Limited. It is engaged in transportation of building material, and it made payment for hiring some dumpers for the same. Okay. So it is engaged in some transportation material. So therefore, for that purpose, they need some dumpers, trucks, etc. So they made some payment for the hiring of dumpers. They did not deduct TDS under 194I because they were saying that we are not using any plant and machinery over here. Therefore, we will not deduct TDS. Now, the auditor has a different view. The auditor says that you should deduct TDS under 194C because it is in the nature of contract. See, the question over here is, the assessee is saying something else and the auditor is saying something else. In that case, what is the responsibility of the auditor? The responsibility of the auditor is, first of all, is to report under clause 34A, that is on TDS reporting, and clause 21B, that is on disallowance if you do not deduct the TDS. First of all, you have to report in both the cases. Okay. TDS reporting, clause 34A. What is written in clause 34A? Name of the deductee, timing of deduction, when it is deducted, when it is paid, when it is supposed to be paid, delay, number of days delay in deduction, etc. With all those columnar details you have to give in 34A. In 21B, you are supposed to write down how much is disallowed if you are not deducted the TDS. Now, the law says that if there is a difference in opinion between the tax auditor and the assessee, the auditor has to write both the views. Okay, the auditor has to report that there is a difference in opinion between assessee and the auditor. If he does not report the difference in opinion, then he is guilty under second schedule and he will be accordingly punished. I hope it is clear to all of you. Next question. SD Pharmaceutical Company, which is formed in 2001-2002, has purchased a new plant and machinery of 12 lakhs. The total income of the assessee is 22 lakhs before allowing additional depreciation. Okay. The turnover of last year is 338 crores. Now we are supposed to compute the tax of the assessee in the most beneficial manner. In the most beneficial manner, we are supposed to compute. See, there are two options. First, compute as per normal provision. As per normal provision, what is the total income? 22 lakhs. Will I get additional depreciation in normal provision? Yes, take additional depreciation on this 12 lakh rupees because you are a manufacturer, you are a pharmaceutical company, you are engaged in manufacturing, etc. Okay, you can take what? Additional depreciation, and on that you will apply 25% tax. Why? Because the turnover of last year is less than 400 crore, 25% tax, and then apply 4% tax. This is first option. Second, you can go for special provision also. Which one, sir? 115 BAA or BAB? BAB is not possible. See, BAB is not possible because the company is not new. It's an old company, na. BAB is only possible if it's a company, if the company is new and it is incorporated between 2019 to 2024. BAB is not possible. Only 115 BAA is possible. If we compute BAA, then you have to directly tax 22 lakhs. Additional depreciation will not be allowed on this 12 lakh rupees. On 22 lakhs, directly take 22% tax, 10% surcharge, 4% cess, and then whatever amount will come, that will be your final answer. Okay, I hope it is clear to all of you. Now the next question also we have done earlier. You can check it if you want. You can see all the adjustments we have done earlier in the past RTP at least twice. Okay. I hope it is clear to all of you. So this is what this MTP is all about. We have completed successfully 6 MTPs so far. So let's go ahead with the next one. MTP Series 1, May 2025. Okay. Now this is the most hopeless MTP that ICI can ever make. Okay. Now see how they have copied the things. You will come to know. You are supposed to compute total income. As per the normal provision, don't follow 115BAA, don't follow 115BAB. Ignore MAT also. Don't follow all those things. Okay. Just follow the normal provision. Narmada Limited engage in manufacturing. The profit is 350 lakhs. You are paying 1 lakh rupees to the independent directors without deducting the TDS. So you should deduct TDS under 194J because you are making the payment to the directors for board meeting. You are not deducting the TDS. Therefore, 30% will be disallowed under section 40A1A. Next, opening stock and closing stock both are overvalued by 10%. Now, if opening stock is overvalued, it is 200. Though it is overvalued means it is 110%. So therefore, 10% is how much cross multiply and add back that because you are overvaluing your debit side. So add back that. Even closing stock is overvalued, so reduce that. Okay. Closing stock is overvalued. 255 lakhs is 110%. 10% is how much? So on the P&L credit side is overvalued, so reduce that. Okay. I hope it is clear to all of you. Next one, depreciation as per books of accounts, you will add back. Next one, 9 lakh rupees you are paying to National Laboratory, that is allowed under section 35 2AA under the old regime. Under 115BAA and BAB it is not allowed, but here it is allowed. Now GST you have not paid, you have paid late on 27 December, that is after the due date of filing of return, therefore this is disallowed. Okay. You are purchasing goods of 63 lakh rupees from your associate enterprise, from your related party at a higher price. The market value is 58 lakhs. You are purchasing at 63. Therefore, 5 lakh rupees will be disallowed. Okay. You are as per 48(2), 5 lakh rupees will be added back. Now, you are making cash payment of 5 lakh rupees. Not allowed. If the supplier is demanding cash payment, so you will pay cash or what? This is disallowed as per 48(3). Then you are making 40,000 rupees to hire a lorry. That is also disallowed. For hiring a lorry, you have a higher limit up to 35,000 rupees, but 40,000 is not allowed. Second payment you are making of 35,000 rupees, that will be allowed because for road transporter, you can make the payment up to 35,000 rupees in cash. 52,000 not allowed. Okay, so 5 lakh disallow, 40,000 also disallow, 52,000 also disallowed, but 35,000 will be allowed. Then same adjustment, legal expenses for issuing bonus shares will be allowed. Legal expenses for issuing right shares will not be allowed. Donation to political party will be disallowed here, but you can claim deduction under chapter 680 GGB. Okay. Normal depreciation you can claim 62 lakhs. And then you are recovering some bad debts of 2 lakh rupees which was claimed as deduction earlier. So recovery of bad debts which was claimed as deduction is deemed income, but you are not giving that effect in the books of accounts. So add back this 2 lakh rupees. Okay. As per section 41 subsection 4. Then your turnover of last year is 390 crore. Therefore, you will be subject to 25% tax. I hope it is clear to all of you. Is it clear? Now, your ICAI, your beloved ICAI, which has a budget of crores of rupees to Board of Studies to make MTPs for students, right? See, such kind of hopeless question they have made. Yes, all the adjustments were repeated. Now forget about adjustment, entire questions are repeated now. See, this question we have already done. Check it. In RTP May 2023, question number 5. I am giving the reference directly so that you should not blame me. Sir, you don't want to solve, you are saying anything. I am not saying anything. See, RTP May 2025, you can open and check question number 5. Okay. Okay. Same question it is. Same. So they have not put any efforts. Put the same question, copy it from there, and they have changed the dates and put that. Now, the next question is a beautiful question. One of the best questions that you can ever have in the entire DTAA chapter. One of the best questions of DTAA. Shall I? Let's start. Lokesh is a 50-year-old person. He is working in a company in India since 2019. He derived income from multiple places. Okay. Therefore, his world income will be taxable because he stays in India only. Okay. First of all, he is earning a salary of 23 lakh rupees before standard deduction. Now, Lokesh is following which regime? Pays tax under default regime. Therefore, Lokesh will be following default regime. Therefore, he will get 75,000 standard deduction here. Okay. So, he is following new regime, not old regime. So, 23 lakhs minus 75,000 will be the salary income. Then he is paying 1,80,000 for SOP. Self-occupied property deductions are not allowed under new regime. This will be not be allowed. So, this 1,80,000 will not be allowed under new regime. In old regime, self-occupied property interest is allowed. Next, income from bank deposit, IFOS 1,60,000 you can take. These are his Indian incomes. Now he has some foreign income also. He is also earning some income from country A. He's earning 25,000 from business income from country A. So I will convert that into rupees as per TTBR on the last day of the financial year. Then the TTBR on the last day of the financial year is 71 rupees. So I will convert this $25,000 into 71 rupees. Okay. Then he's earning some house property income from foreign country. This will also I will convert as per TTBR on the last day of the financial year as per rule 115. Then I will take 450 rupees. What? 450 rupees standard deduction. In foreign country it is not allowed, but in India it is allowed. Na? So I will take 450 deduction of what? Municipal tax. Then I will take 30% standard deduction. And then whatever amount will come, that I will convert into what? That I will convert into a TTBR on the last day of the financial year. Next income. Is also earning dividend. Now for dividend you have to take TTBR of the last day of the preceding month, not last day of the financial year. So you are earning dividend in March, so you will take TTBR of 28th Feb 2025. Okay, I hope it is clear. So you will convert that as per that rate. And for short-term capital gains, $5,000. For that also you are supposed to take TTBR on the last day of the preceding month, not last day of the financial year as per rule 115. So for this $5,000 on short-term capital gains, I will take TTBR on 28th Feb 2025. After this, I will get what? I will get my total income. Okay, no deduction, no chapter 6 and nothing is allowed under the new regime. Now, after that, I will compute tax. I will compute tax. Listen carefully. I will compute tax as per the new regime. Okay. Now, I am computing the tax payable in India. Listen carefully now. And then I need to compute the average rate. Now, how will I get the answer? See. What all things will come in my total income? First of all, 23 lakh minus 75,000, 2375, that I will take. SOP I cannot take. When I convert house property income, it comes to 2,01,285 rupees. These are all in rupees. Huh? Business income comes to 1775, STCG comes to 3 lakh 50 and dividend comes to 7 lakhs. Okay. This is my Indian income. Now the average rate comes to 27.76%. When I take the total tax, you can go and see the solution. When I take the total tax divided by total income, my average rate comes to 27.767. Now how much relief I will get? I will get the relief of tax payable in India on doubly tax income or tax payable in foreign country of doubly tax income, whichever is lower. What is tax payable in India? On house property is a doubly tax income, business is a doubly tax income, short-term capital gain is a doubly tax income, dividend is a doubly tax income. Salary is not doubly taxed, that is only taxed in India. So these four incomes are doubly tax income and this is the Indian average rate. So this will be the first tax. Okay. Now what is the tax payable in foreign country? For that I need to find out the foreign income. First of all, I am earning $25,000 from business. Then I am earning $4,500 from house property. Now I will not reduce 450 because in foreign country I am not paying tax on 450 because I am not getting deduction in 450. In foreign country I am paying tax on $4,500. In India I am getting deduction of 450 rupees. In foreign country I am not getting deduction of 450. Then $10,000 of dividend and $5,000 of short-term capital gains. This is the total income which I have earned in foreign country. On this I am going to pay 20% tax in foreign country as it is mentioned over here. Now, this tax I am paying on which date? I am paying on 25th of May. Now, I have to convert this into rupees. How will I convert this into rupees? I will apply rule 128 now. To convert the foreign tax into Indian tax. To convert the foreign tax into Indian rupees, I have to take TTBR on the last day of the preceding month. So, now this is paid on 25th of May. Whatever tax will come on 44,500, that is going to be around 44,500 into 20%. You can do it 8,900 rupees, something around that, $8,900. Whatever tax will come, that tax I am going to pay in the month of March to May 2025. So I will convert that into rupees as per TTBR of the preceding month. That is as per 30th April. So I will convert this as per 30th April and whatever tax will come, that will become my second tax. And then I will compare first and second, whichever is lower, that will be allowed as a relief. So it's a beautiful question on DTAA. Okay. So you have to do this question. It's a beautiful question. They can repeat this. Okay. Now the next question is something which we have done earlier, actually speaking. But if you want, I will do it again for you all. We have done this question. Check it, please. There is a trust, Feed People Limited. It gets merged with another trust on 1st April, which is not eligible for 12AB. So what will happen? Exit tax will apply. If a trust, which is eligible for 12AB, it is getting merged with another trust, which is not eligible for 12AB. So you have to pay exit tax. Okay. Now, first of all, for land, what value you are going to take? Stamp duty value or market value, whichever is higher. Okay. Therefore, market value is higher. You will take market value. For equity shares, you are going to take average of highest and lowest price. For preference shares, you are going to take market value. Outside liability, you will take. Provision for tax, you will not take. And liability in respect of various bill payment also you will take in the total of liability. Then take all assets minus all liability, you will get what? Your net assets. You will get your accredited income. On that you apply 34.944% tax. Okay, I hope it is clear to all of you. Now the next question is also a very beautiful question. Okay, there are some minute points which I have told you in the class which you have to remember. Again, I will tell you today also. Fashion INC, it's a notified financial foreign institutional investor, which is an FII. We need to compute the total income of the FII and the tax liability of the FII as per 115 AD. As per what? As per 115 AD. Okay, so now pay attention. First of all, the FII is earning dividend income from Indian company, so that is subject to 20% tax as per 115 AD. Then the FII is earning interest on security, that is also subject to 20% tax on 16,70,000 rupees. Expenses are not allowed under 115 AD. 115 AD does not allow you the deduction of expenses. So don't take the deduction of expenses. I hope it is clear to all of you. Next one, this is very important. The associate has purchased some bond in 2018. They are selling the bond in 2025. So they are selling for 58 lakh. They have purchased for 33 lakh, 15 lakhs long-term capital gains. Now this will be subject to 10% tax. Why, sir? This is not subject to 12.5%. No, this is the only place under the entire income tax law. Remember, in 115 AD, the normal long-term capital gains, the rate has not been increased to 12.5%. It is still 10%. Yes, 112 long-term capital gain has been increased to 12.5% under 115 AD, but the normal long-term capital gains has not been increased to 12.5%. So this will be subject to 10% tax. Now, the listed shares purchased in 2024 May and sold in February 2025. So it is a short-term capital gains. It is sold within 12 months. So it will be subject to 20% tax under 111A STCG. Unlisted shares purchased in 2024, sold in 2025, sold within 24 months. Therefore, the short-term capital gains under 115 AD are subject to flat 30% tax. Okay, flat 30% tax is applicable under 115 AD for short-term capital gains. I hope it is clear to all of you. Let's go ahead with the next question, which is on TDS. The first question over here is, you are buying some property in Chennai for 85 lakh rupees. So you should deduct TDS under 194 IA at the rate of 1% on actual consideration or stamp duty value, whichever is higher. In this question, stamp duty value is not given, so forget about that. Now, because the actual consideration is more than equal to 50 lakh rupees, you will deduct TDS at the rate of 1% on 85 lakh rupees. Next one, you are buying an urban plot of 49 lakhs. You will not be subject to TDS because the amount is less than 50 lakh rupees. You are buying a rural agricultural land of 55 lakhs. You will not be subject to what? You will not be subject to what? TDS. On urban plot, I am sorry. For urban plot, you will deduct TDS because the limit is 49,000, but the stamp duty value is for 54 lakhs. Therefore, you will deduct TDS at the rate of 1% on 54 lakhs. You will not consider the actual consideration, but you will see the stamp duty value of the urban plot, because whichever is higher is more than 50 lakh rupees. Therefore, you will deduct TDS at the rate of 1% on 54 lakhs. On this rural agricultural land, you will not deduct TDS. Okay, I hope it is clear to all of you. This notified infrastructure debt fund, same adjustment we have done earlier, if you remember, just some time before. Next, you are paying some landing and parking charges to Airport Authority of India. So if an airline company pays landing and parking charges to Airport Authority of India, that is subject to TDS under 194C and not 194I. That is subject to TDS under where? 194C and not under 194I. Okay. Next, you are an employee of central government who are receiving some arrears of salary. So now the question is, while deducting the TDS, whether this arrears of salary will also be deducted or the entire salary will be subject to tax. So this arrears of salary, you will get a rebate, you will get a relief under section 89 for this arrears of salary if you give form number 10E. Remember, I have mentioned all these things in your color book. If you go and check your color book, you will see form 10E you have to fill and give. I have also done one question in the question bank based on this form 10E in the chapter of TDS. You can go and check. This is the level of depth we have done in our class as far as your CA final exams are considered. So therefore, the TDS will be deducted after giving you a relief under section 89 as per section 89, and for that the assessee has to give to the government what? Form 10E, the declaration. Next question we have done earlier in RTP May 2024, question number 5. You can check the same question we have done earlier, so don't waste time on this. Okay, now next question is a beautiful question. There are some good questions over here. Yes, it's a big RTP. It's a big MTP. Now, next question. Question number 5. Question number 5, subpoint A. Point A, subpoint A. Now, Income Tax Authority did not file an appeal in your case. Okay, now listen carefully. Suppose Income Tax Authority, there is an assessee by the name called as Bela. Now, Income Tax Department did not file an appeal in case of Bela. Why? Because it was not exceeding the tax effect. There is some tax effect now for department to file an appeal. Remember that in case of If you want to appeal to ITAT, then it has to be more than 60 lakh rupees, or High Court more than 2 crore, Supreme Court more than 5 crore. There is some tax effect now. So in the current year, suppose I have not filed an appeal against you because department has not filed an appeal against you because the tax effect is not more than 60 lakhs. Can you stop me to file an appeal in the next year? The answer is no. Can you stop my neighbor? Can you stop the department to file a case in case of your neighbor? Because in your case it was not filed, so in your neighbor's case also it should not be filed. Is it so? The answer is no. Remember, there is a provision by the number called as 268A, which talks about that this particular relaxation is given only for a particular year in case of a particular assessee. Now, in case of Bela, if the department is not appealing in the current year, that does not restrict the department to not appeal in the next year also. In the next year, department wants, they can appeal. My neighbor, if they want to appeal in the current year also, they can appeal. My neighbor cannot give a reference of Bela that in case of Bela you are not appealing. Why are you all appealing? In my case, you cannot give that reference. I hope it is clear to all of you. Is it clear? I hope it is clear to all of you. Now, next question is also a beautiful question. There is an assessing officer who filed a complaint against a firm. The firm did not file the return. Okay. Now, if you don't file the return, and if there is a willful failure to file the return, then there can be a prosecution against you for 3 months, minimum 3 months. So if there is a willful failure to file the return, there can be prosecution which can be launched by the assessing officer against you. Now, in this case, you have not filed the income tax return. Okay. Now, the tax payable in your case was 70,000. You went to appeal. After you went to appeal, the appellate authority reduced the tax to 9,100 rupees. Listen carefully. You have not filed the return. The tax payable in your case was 70,000 rupees. You went to appeal. In the appellate authority reduced the tax payable to 9,100. Now listen the provision. If there is a willful failure to file the return, there can be prosecution. But for an assessee other than company, if the tax payable is less than 10,000 rupees, for an assessee other than company, which is the assessee is not a company, it is other than company, it is a firm. For an assessee other than company, if the tax payable is less than 10,000 rupees, then in that case prosecution cannot be launched. Therefore, in this case also prosecution cannot be launched on the assessee. I hope it is clear to all of you. Now, the next question also exactly same question. RTP May 2025, black money law. Same question the ICI has copy pasted over here. You can check it over here. Same question, same copy paste. You can check it over here. This question is a theory question, so I am not interested in that. Now, next 2-3 questions are good questions, so I am discussing them. Okay. First of all, the AO is doing survey at 9:30 p.m. First of all, can a AO do survey at 9:30 p.m.? Why not? Generally, AO cannot do survey after sunset, right? After sunset, he cannot enter your premise. But if your business hours is in night, he can do that. See, here the business hour is in 5 a.m. to 10 p.m. So if the business hours is from 5 a.m. in the morning to 10 p.m. in the evening, then the AO can definitely enter your place at 9:30 p.m. with a prior approval, obviously. Okay. Second thing, in the survey, can he take cash? No. In the survey, he does not have the power to seize the cash. For that, he need to go for search and seizure. Second, in the survey, can he take your books of accounts? Yes, he can take the books of accounts into his custody, but without recording the reasons, he cannot take. He need to record the reasons. Plus, if he wants to take the books of accounts for more than 15 days, then he have to take the approval from higher authority. Without taking the approval from higher authority, he cannot take. So first of all, he has to record the reasons. Recording the reason is mandatory. And if you want to take the books for more than 15 days, then you need to take the approval from higher authority. I hope it is clear to all of you. Next one. You need to answer whether this is tax planning or management. Very simple question. Nothing great as such. First of all, you are putting 1,50,000 in PPF. Obviously, this is tax planning. Investing in PPF is allowed as per ATC, as per income tax law. It is tax planning. There is nothing wrong in that. Okay. Next, you are purchasing some air conditioner and you are putting in director's home and you are claiming depreciation under the income tax law. This is tax evasion. You are purchasing air conditioner for whom? For director, na? Then why are you claiming depreciation under the income tax law? It's a tax evasion. Don't do this. Okay. Next one, there is a foreign national. Foreign national who is also a non-resident. Okay. Foreign hockey player who is also a non-resident. Therefore, 115 BBA will apply. 194 E will apply. And whatever he will earn from playing, that will be subject to 20% tax. Whatever he will earn from writing an article about hockey, that will also be subject to 20% tax. Whatever he will earn from advertisement, that will also be subject to 20% tax. And whatever he will earn from lottery, that will be subject to 30% tax. So you need to net off, this is net of TDS, so lottery you have to gross up. 69,100 is, you have to gross it up with 30%. Okay, I hope it is clear to all of you. 31.2% you have to gross it up. Now, Examine whether the above incomes are subject to deduction of TDS. Yes. The first two incomes will be subject to 20% TDS under 194E, and the lottery income will be subject to TDS under 194B. Is he supposed to file the return? The answer is yes. Exemption from return is available when you earn only 115 BBA income. If you earn only 115 BBA income and if TDS is deducted, then you are not supposed to file the return. But apart from 115 BBA income, he is also earning lottery income. Therefore, he is liable to what? He is liable to file the income tax return. I hope it is clear to all of you. And one last question in this particular MTP is as follows. The non-resident has made an application for authority for advance ruling on 15th of June. Now on 21st of July 2024, it wants to withdraw the said application. Can it withdraw? See, there is a provision for withdrawal of application from board for advance ruling. That is, once you make an application, you can withdraw an application within 30 days from the date of application. Now, are you withdrawing within 30 days from the date of application? The answer is no. You are making an application on 15th of June. You are withdrawing after 30 days. But there is a AAR ruling on this which says that the AAR will allow you to withdraw the application even beyond 30 days if the circumstances so justify. So, in case of genuine case, you will be allowed to withdraw the application even after 30 days. By default, it is 30 days from the date of application. But if you can prove the reason why you were not able to come within 30 days, then they will allow beyond 30 days also. I hope it is clear to all of you. So, this is what this MTP is all about. Is this clear? Please tell me. Now, let's go ahead with the last MTP, MTP Series 2, May 2025. Now, many questions are repeated in this. The first question itself is completely repeated. Check. It is exactly the same question as RTP November 2022 question number 2. Exactly same question. Okay. Whether the PDF is available? Yes, it is already available in our Telegram channel. Join our Telegram channel, CA Aarish Khan. I'll put the link below in the comment box also. You can check it over there. Okay. This is exactly the same question which we have done earlier. Okay. Question number 2. Exactly the same question we have done earlier. Exactly. Question number 3. Exactly the same question. This one. This MTP is totally copied. I have told you now, May 25 MTPs are hopeless MTPs. ICI has not put any efforts for you all. Sorry. Okay. This is a very simple question we have done earlier. DTAA question. Same. This question we have done earlier. Till question number 3, everything is same. I am giving the reference. You can check it if you want. Or you are also reading now. You are also come to know that what we have done, what we have not done. I am not going to lie to you all, obviously. Yes, this is a different question. Okay, so we are going to do this question. A charitable trust is there under 12AB which is earning the following incomes. First 14 lakh rupees from the property, so I will write that in the income statement. Then 6 lakh rupees as net income from business incidental to main objective, that I will write in the income statement. Then 9 lakh rupees from voluntary contribution, that I will write over it. Total 29 lakh rupees is the income, out of which 15% exemption the trust will get. I will take that ad hoc exemption of 15%. Now, there is some catch over here in this last line. The trust has applied 12.8 lakh rupees towards charitable trust, which includes repayment of loan of 4.8 lakhs. But the purpose for which you have taken the loan, you have claimed that purpose as an expenditure earlier in 2021. For example, in 2021, you have taken a loan of 4.8 lakh rupees for buying a land. And in 2021, you have claimed that land expenditure as a deduction. So, will you get the deduction of repayment of loan again as deduction? The answer is no. Again, I am saying, say in 2021, you have taken a loan of 4.8 lakhs and you have purchased the land. While purchasing the land, you claim that as an application. So now in 2024-25, while repaying that loan for which you have already claimed as an application, will you get the deduction? The answer is no. The answer is no. Therefore, that I will reduce from 12.8 lakhs. So if I reduce from 12.8 lakhs, 4.8 lakhs, 8 lakhs will be allowed as what? A deduction. Now you will tell me, sir, when you take a loan and incur an expenditure, that is not allowed only now. It is allowed only on payment. That amendment came from Finance Act 2021. And this matter is of before 2021. That is the reason this issue will arise over here. I hope it is clear to all of you. Okay. So before 2021, before 31st March 2021, it was not like that, that when you repay the loan only then it is allowed. No. At that time when you take a loan and incur the expenditure, it was allowed. And when you repay the loan, it was not allowed. But now the thing is opposite. Now from 2021, when you take a loan, incur an expenditure is not allowed. When you repay the loan in 5 years, then it is allowed. I hope it is clear to all of you. Okay. Now the next question also we have done completely. Check it please. We have done this question just now in MTP, one of the MTPs. Remember or not? 12% guarantee. Then you need to check the AO has passed an order on 31st of March. Then secondary adjustment, all same adjust, same question they have repeated over here. Okay. Now the next question is a good question on TDS. Generally, please tell me, the bank is supposed to deduct TDS of the customers if the payment of the interest is more than 40,000. And if the assessee is senior citizen, then in that case, the TDS, the interest payment has to be more than 50,000 rupees. Then the bank is liable to deduct the TDS under 194A. Now, please tell me one thing. All of you think I have told you this in the class also, that does the bank compute interest on a daily basis? The answer is yes. The bank compute interest on a daily basis, and whatever interest is computed, they credit to a separate account. Okay, they credit to a separate account, not to the customer account, to a separate account for their monitoring purpose. But interest is paid to the customer on what basis? On some interval basis, 3 months, 6 months, 1 year. Okay. So whatever amount is computed on a daily basis, is TDS applicable on that? The answer is no. TDS is not applicable on the amount which is computed by the bank on a daily basis. TDS will be applicable only when the amount will be credited to the customer's account. Whenever it is credited, at that time TDS will be applicable. That is what it is written over here. The assessing officer was disallowing the interest expenditure. 30% expenditure was disallowed by the assessing officer just because the assessee was computing the interest and crediting to a separate account for monitoring purpose. You cannot do that. Okay, it is not allowed to do that. The AO is wrong. Next one. Profit commission of 1 lakh is paid by reinsurance company to the insurance company. TDS is not applicable. Generally 194D. 194D says what? 194D talks about insurance commission, but that excludes reinsurance. Go and check. 194D does not include reinsurance. Therefore, profit commission will not be subject to TDS under 194D. Next one. Amrish, a part-time director, was paid an amount of 3,10,000 rupees in the nature of commission. Therefore, TDS will be deducted under 194J. Whatever commission you pay over and above salary to the director is subject to TDS under 194J. And for director, there is no limit also of 30,000. See, generally there is a limit of 30,000 to deduct TDS under 194J. But for directors, there is no limit of 30,000 also under 194J. I hope it is clear to all of you. Next one is a very simple question on what? Very simple question of equalization levy, which we have done earlier. There is an Indian company, there is a foreign company who does not have a P in India. That foreign company is giving us online advertisement service. We are making a payment of 20 lakh rupees. So deduct equalization levy. Same question we have done some time before. Same question, 6% deduct. Pay by 7th of the following month. If you do not deduct, do not pay, you will be liable for interest, you will be liable for penalty, and the expenditure of 20 lakhs will also be disallowed. If you deduct and pay, then the income will be exempt under section 1050 in the hands of the foreign company. Next one is a theory question which I have discussed with you all earlier. The board for advance ruling has the power of issuing commission. Yes, the board for advance ruling has the same powers which are mentioned under section 131. That is the power to issue summon. That is, I'll again say the 4 powers which are given under 131. The power to discover and inspect, the power to compel production of books of account, the power to enforce attendance, and the power to issue commission. These 4 powers are there with the board for advance ruling. Next one, we need to identify whether the following persons are liable to file the income tax return or not as per 139. So if there is a person whose turnover of business is 70 lakh rupees, is he liable to file the income tax return? The answer is yes. If you are doing a business and if your turnover is more than 60 lakh rupees, you are liable to file the income tax return. Next. If you are depositing 50 lakh rupees in your saving bank account, are you supposed to file the income tax return? The answer is yes. If any individual, HF, etc. are depositing 50 lakh rupees or more in saving bank account, you are supposed to file the income tax return. I hope it is clear to all of you. Next one is a very good point which we have done earlier also in the form of case law in RTP, not in MTP. That is, ITAD has passed an order. Now, after passing the order, can ITAD reappreciate the evidence produced during the proceedings of the appeal while hearing the rectification application? Listen carefully. ITAD has passed the order under section 254. Now, after a few months, the ITAD is calling for the rectification of the order because there is some apparent mistake. Now, while rectifying that apparent mistake, can ITAD reappreciate the entire matter once again? And the answer is no. The ITAD cannot have the power, does not have the power to review the order. The ITAD only has the power to rectify an apparent mistake. It cannot reappreciate the entire matter once again. Second, the High Court cannot interfere into the factual finding recorded by the lower authority or tribunal without any valid reason. Correct. That is also correct because the High Court does not have the power to get into the question of fact. The High Court only has the power to get into the question of law, because ITAT is the last fact finding authority. If any fact has to be raised above ITAT, that is not possible. ITAT will only, after ITAT, the High Court and Supreme Court will only take care of the issues which are substantial question of law. Therefore, High Court does not have the power to interfere into the fact which is already recorded by the tribunal or lower authority, especially when there is no valid reason only to interfere. Okay, I hope it is clear to all of you. Next one is a penalty which we are supposed to compute as per 270A. It is an Indian company and the turnover of last year is 350 crore. Therefore, the tax rate will be 25%. Do not follow any special regime. Follow the normal regime. Now, and the penalty is not on account of misreporting. Therefore, the penalty will be 50%. Now, when is the first time the penalty will be imposed? The penalty will be imposed when the assessment will be done under 143. So, how will you compute the underreported income? That is income assessed, that is 5 lakh loss, minus income process, that is 7,50,000 loss. So, that will come to 2.5 lakh positive. So, in case of loss, you have to directly compute the tax. Okay, directly compute tax on 2.5 lakhs. On 2.5 lakhs, compute 25% tax and 4% cess, and whatever tax will come on that, apply 50% penalty. Now, second time when the penalty will be imposed under 147, that is income reassessed 4,50,000 minus income previously assessed negative 5 lakh. Therefore, underreported income will come to 9.5 lakhs. On 9.5 lakhs, you will directly apply 25% tax on 4% tax, because again it's a case of loss. In case of losses, you have to directly compute the tax for the purpose of computation of penalty, and then apply what? 50% penalty on your tax. Okay, and one last question. Not one last question, three more questions are there. Now, the next question is a theory question. You can go through this theory question as per your convenience whenever you want. Sixth question, we will come to this question. This question has 3 parts, and this is the last question of this MTP. Out of which, the first question we have done in our class, not in MTP RTP. So I am telling you, because there is a mistake done by ICAI over here. See what has happened in this question. A search was conducted under section 132 on 31st of October 2024, and the department has seized 25 lakh rupees cash. Now, the assessee has submitted the application on 15th of December requesting to release the cash. Okay, now listen carefully. I have told you earlier also in one of the MTP today that suppose if a search is conducted today, then and the department has seized something, in this case the department has seized 25 lakh rupees cash, then the department will give you 30 days from the end of the month, 30 days from the end of the month to come and explain the nature and source, and then they will take the existing liability from 25 lakh rupees, and the balance they will give you within what? Within 120 days. Now, in this case, the assessee, the search was conducted on 31st October. So 30 days from the end of the month will expire on what? Will expire on 30th November. The assessee is going for application on what? 15 December. Honestly speaking, the assessee is late. But the ICAI has said that it is on time. I don't know why ICAI has said that it is on time, but it is a mistake. Okay, ICAI has made a mistake over here. The same question is there in their study material also, but in the study material they have written 27th of November. What they have written? 27th November. But here they have changed the date. In the process of changing the date to make a question, to try to make a question, a new question, they have made a mistake only in the question. Okay, therefore the correct answer of this particular question will be the assessee cannot go for what? For asking for release of the assets of 25 lakh rupees. The provision is not applicable in this particular case, but ICAI has given a different answer, which is a wrong answer according to me. Okay, now the next question is a beautiful question on GAR. There is a country X, there is a country X, which is a foreign country. There is a company X Limited in foreign country. There is India. There is Red Chilies Entertainment Limited in India. Now remember, there is a DTAA between India and country X, which says that if the foreign company has more than 10% stake in Indian entity, then it will be subject to tax in India. Okay, so if the foreign company has more than 10% stake in Indian entity, then it will be subject to tax in India. So what the foreign company is doing? It is trying to invest around 18-19% in India. But if it invests 18-19% in Red Chilies, then it will be subject to tax in India. So what are they doing? They are making 2 separate subsidiaries in country X by the name called as Lalit and by the name called as Mohan. And they are what? Telling Lalit to hold 9.95% and they are telling Mohan to hold 9.95%. Okay. Now, because of which, what will happen? Lalit is holding less than 10%. Mohan is also holding less than 10%. And therefore, the investment in India of any of them, neither of X Limited, nor of Lalit, nor of Mohan, is more than 10%. Therefore, they will not be subject to tax in India. So, but this is a clear case of tax avoidance. Therefore, why? Because there is no commercial substance of making these two subsidiary. Is there any commercial substance of making these two subsidiaries? The answer is no. You are making these two subsidiaries only to evade tax in India. Therefore, the assessing officer will negate the benefit of treaty and will not give you the benefit of treaty, and GAR will be applied on you in this particular case. And one last thing over here is a case of what poem? There is a foreign company, Mischief Limited, and 55% of its shares are held by Kaveri Private Limited, an Indian company. We need to find out whether this Mischief Limited is a resident or non-resident in India. For that, we need to check the ABOI test. If all the conditions of ABOI test are fulfilled, then the assessee is non-resident. What is the first condition of ABOI test? The passive income is less than equal to 50% of the total income. Now, what does passive income include? Income, first of all, is this passive income? Is this passive income? Income from trading operation? No, this is not passive income. Second, income from transactions where purchase are from associate enterprise and sales are from unrelated parties. Is this passive income? No, this is also not passive income. Passive income includes where both purchase and sales are from associate enterprise. That income will be called as a passive income. This is not passive income. Income from transaction where sales are to associate enterprise and purchase are from unrelated party. This is also not passive income. Where both purchase and sale are to or from associate enterprise, that is passive income. Therefore, this 5 lakhs and this 10 lakh is passive income, and interest, dividend, capital gain, royalty, and one more item, rental. These 5 incomes are always passive income. Therefore, this 20 lakhs and 15 lakhs is also passive income. Therefore, what is passive income? 10 plus 5, 15. 20 plus 15, total 50 lakh rupees, 50 crore is passive income. And what is your total income? Total all of them, you will get 110 crore. Therefore, your passive income is less than equal to 50% of total income. Now, what is the second condition? Your Indian assets should be less than 50% of total assets. So, take Indian assets 210, take total assets 610. That is also less than 50% of total income. Next, what is your third condition? Your Indian employees should be less than equal to total employee 50% of total employees. Your Indian employees are 70, your total employees are 160. So that is also less than 50% of total, less than 50% of the total employees. And your payroll expense for Indian employees or who are a resident in India should also be less than 50% of the total expenditure. So your Indian payroll expense is 8 crore and your total payroll expense is 20 crore. So this is also less than equal to less than 50%. So all the 4 conditions are fulfilled. Now ABOI test is passed. Now one last test. If majority of the board meetings are held outside India, the assessee is non-resident. So out of the 8 board meetings, only 3 are held in India and 5 are held in Maldives. Therefore, the 5th condition is also fulfilled. Therefore, the assessee can be called as what? The assessee can be called as non-resident. So this is what this MTP is all about, and this is where we have completed all the 8 MTPs in full English along with 9 RTPs, 9 past papers, total 26 papers for you all. Whatever I could have done from my side for you all in full English, I have done it. Okay. I hope you all have enjoyed this. If you have enjoyed this, I have one sincere request. You share this video with maximum of your friends to the extent possible. This much you can do it for me. Second, you please comment below that what is your experience in the comment box, not in the chat box, in the live lecture. As I am taking this live, not in the live chat, but in the comment box. Okay. So this took a lot of efforts from my side, okay, but I really love working hard for you all. It's not that I am taking a full English lecture, so I am blaming myself. What is this? I have to take again. I enjoy this. I really enjoy taking it for you all separately in full English, because of which you guys are getting benefited. Nothing can be greater than that for me. Okay. So that's it from my side. Very soon I'll be coming with 1 or 2 more things. I will also revise capital gains for you all. If you are ready, we will revise capital gains fully live if you want in the next 3-4 days. If you want, we can do that also. Okay. Because if capital gains, if I revise, then most of the big topics we have done the revision. Okay. So take care all of you. Bye. See you soon with some more exciting videos. And I will also I'll also be putting the combined video of all 26 papers in one single shot. Okay. That will also be uploaded for you all. Bye all of you. Take care.